over year's 40 million. Quarter over
Yeah,
quarter is
sorry.
like,
Quarter
like
is not bad.
7 million.
Yeah, you're
We're
right.
live.
All right. Hello. Welcome to SoFi Q2 earnings report. We've got Christopher Hager. We got Tevis. We got Tanner. We got myself. We got 30 minutes until the earnings call. So let's go with the raw thoughts. Chris, I know you've had a couple minutes to digest everything, but what are your raw thoughts?
This was an excellent quarter. So what I put in the tweet is that the only downside that I can see is that we increased SBC by about 12 million, which is a lot, which we kind of saw coming. There was in first quarter, they had a lot of RSUs that were issued. But other than that, triple beat, right? The EBITDA raise was like $45 million, which considering you're going from a base of 282, right? It's like more than a 10% increase in the EBITDA raise, which again, I talked about earlier, but personal loan originations are really high. That shows me that, and maybe I'm wrong here, but I don't think they're worried about selling personal loans. Otherwise you wouldn't lean into it. And then the member ads was insane, absolutely crazy. So the EPS came in not as good as you'd probably hope, but man, the growth is just insane. And it's totally, I don't know, I'm not worried about that. I'd rather have us adding almost 600,000 members in a quarter and have the EPS a little lower for now. Yeah, no, awesome quarter. I don't know. I haven't checked the stock price in a minute. Yeah, we're down a little bit in stock. I don't care.
Yeah.
Yeah.
This was a phenomenal quarter.
Outstanding.
It's crazy. I'm just looking at customer acquisition costs plummeted. We're under $300 a member. It probably has to do with the amount of new Relay members that we got. We got a ton of new, that is going to be the fastest growing product. Honestly, Relay is growing so fast. SoFi Money blew away expectations. I thought, I was like, okay, I'm going to get aggressive. 230,000 new SoFi Money members. It's 280,000.
Well, so that's the thing, though, right? I think that's one of the things that threw me a little bit is that all of us in our earnings expectations were expecting the same strategy of all efforts towards profitability, lower EPS, lower spend, and we're being super conservative on, product numbers, on member numbers, on whatever, because we're all aiming for that profitability. And then we saw SoFi this quarter, and I think it might be what's throwing the market, given the pre-market numbers, is the fact that SoFi is just accelerating spend and just adding more members. And that EPS, I was expecting it to come in at -3 cents or -4 cents even. But inching towards that profitability, because that's the milestone that we've been measuring for, not them increasing their spend,
Yeah, but I don't like Tanner said, if your customer acquisition cost is coming down, why wouldn't you lean into the growth?
Yeah. Yeah, that's very fair.
Oh, and the tech platform, we forgot to mention, it hit all-time high revenue. It re-accelerated back up above where it was last quarter. So the margins are still down. But the tech platform re-acceleration is also super exciting.
Yeah, in terms of things that really didn't land where we wanted it to. I mean, or at least where I was hoping, was student loans really didn't come back at all.
No, they're down quarter over quarter.
Yeah,
but that's expected. They're not supposed to come back until October, November-ish, I'd imagine.
Right. And so, I was hoping for a little bit of a ramp into student loans, and I said, okay, you know what? For the full quarter, I expect 100 million in originations from mortgages, 600 from student loans, and 3 billion from personal loans, which makes 3.7 billion total. Mm-hmm. Well, 3.7 billion, if you guys look through the quarter, did stand out as just being the amount that we originated on personal loans without the added benefit of student or home loans. That's nuts.
That's crazy.
Yeah.
That is pretty insane. This is just, I don't think we expect, did anyone expect 584,000?
No.
I mean, that's
no. So, okay. I've just thrown this up, and I've thrown the stock price up here as well, so you can
Zoom and enhance.
Yeah, but can you guys see the stock price? Okay, I just didn't want to take
Yeah.
too much
Yeah, we can see it.
space. Where do we want to start? Just at the top line.
All of it.
All right, we want to
New
start
members, new products, management.
So 580.
so I guess-
Tanner got the closest again, right? Tanner gets the highest.
Yeah,
Well,
but
I
it's
did
not even
higher
close.
Okay, so let's talk about this. What do you think worked this quarter? Was it the woman commercial? Was it the stadium and the weekend tour? Like, what do you think
more
got?
spend? It's just more spend.
But it's not that much more,
It's
like
not-
Tanner
it's
was saying, right?
It's 100,000 more than we thought, was 7 million more to spend. The CAC cost went down like 25%. This is like
it's
really good.
It's awesome. And the thing is, so here's why I think, like, for me, the long-term thesis seems really confirmed is that, like, if you look at deposits of every other neobank, so, like Ally, even Discover, Lending Club actually had negative quarter-over-quarter deposits, right? They lost deposits this quarter. Whereas SoFi is they're differentiating themselves, right? They had another quarter of huge deposit growth, and they're adding more members than anybody. Like, it seems like the data is suggesting that they have a diversified product offering, despite the fact that, like, their APY isn't as high as, like, Lending Club's APY is higher than SoFi's and has been this whole quarter. But in spite of that, SoFi's seeing significant member growth, which means that, like, there's something else that is drawing people to the platform other than just the APY.
Right. It's a good point. It's a really good
Well,
point.
and so didn't the take rates on our personal loans also go up? And I don't think we can see defaults yet, but we can see what they're expecting, and that didn't move.
Well, but the expectations are just for credit cards. They're not for, so, like, provisions for credit losses are only on credit cards. They're not for
Right. But don't they
personal
have
loans.
the annual default rates printed for? Here, wait, let
I
me try to
don't
find
know
it.
if it's in here.
Thought I saw it at 4.6%. I'll look for it, but yeah.
Weighted
We
annual.
might have to wait for the queue for that.
You have it right here.
Yeah, there it is.
Okay, there we go.
Yeah, so it didn't move. But yet the coupon rate that we're taking went up, which doesn't mean too much. Like, the amount that we could act, that's not how much we're defaulting, really. It's like their projection for how much they want to default, which last quarter I think they were at 2.9%, even though they said it was 4.6%.
Yeah, we'll probably hear that in the call, honestly.
Yeah.
The discount rate went way up, which is, again, that's actually really bad for fair values. So they're baking in quite a bit. I wonder what happened to the hedges. I wonder if that's included here. It's not. At least I controlled F hedge and it wasn't there.
There's no
So that
Wyndham
probably
there yet,
did.
right?
Yeah, I don't know. And I haven't looked at the cash. We could probably back it out.
Yeah.
You're definitely going to talk about it on the call, so.
And from
Yeah.
what I can see, they definitely sold loans. Like, their
that
loans
I
held
haven't
for
looked
sale
at yet.
all went down.
Oh, really?
All of them, yeah. Oh, wait. I maybe could be comparing against the total number here. No, sorry. No, silly comment. Sorry, student loans went down about 140 million, but that honestly could be from.
That to me is exciting because that means
no, student loans was
what?
almost flat. So from Q1 was 5.04 billion, Q2 is 5.1 billion. Right. So actually, no, they held them all just because they didn't originate very much. Personal loans.
Student loan was
went up.
524 last quarter.
Oh, sorry. Yeah, I'm looking at loans. No, I'm looking at loans held for sale between the two balance sheets.
Oh, okay.
Cash went up.
Cash went up. Cash went up by $500 million.
Yeah.
And
Wow.
then personal loans went from 9.6 billion hold to 12. So that's 2.4. So they had to have sold loans because that's the personal loans only went up by 2.4 billion and they originated 3.7 billion. Right? There's over $1 billion of discrepancy there.
Yeah, there is some selling here. But last quarter they did do some selling as well. I think only for student loans or whatever, and way more home
It
loans
was
than expected as well. Did anyone see this?
yeah,
Like
yeah.
went from
That we knew
90
from the
million in
call report.
originations to 243 million, like 750 people that we signed last quarter. I think it was like, here, wait, 750 signed this quarter. Last quarter is 250.
Yeah, no, that's like 150% increase. Like Wyndham Capital has already, I mean, I wouldn't say it's already paying dividends, but that's a huge increase, right? Like,
Mhm.
and that's all down to Wyndham. It's not like home, you know, um, volumes went up quarter over quarter, right? Like, if anything, they went down as mortgage prices increased.
Gee,
Like,
what else do we see?
I don't know what the market wanted to see, but I saw everything that I
Amount of
wanted to
products
see.
per member actually went down, just because we brought on so many members this quarter.
Right here.
Sure.
Is this it? No.
Well, I'm using my metrics. I'm just taking
Yeah, you're just
members
pulling the
over.
numbers.
Yeah, but
So is it
still
is
though,
it still above 1.5 or is it slightly below that?
no, it's 1.507. But
Okay.
last time was 1.513. We're talking about very different, like very, very similar. It's not falling off a cliff or anything. Honestly, I think a lot of people are coming onto the platform. They're getting SoFi money and SoFi Relay out of the gate. Like,
Yep.
and then from there we can choose to cross sell them into other things.
Mm-hmm.
Like,
Yeah.
SoFi Invest doubled the amount of new people that came on the platform. I think that is pretty strong for Robinhood as well. It's just like, dude, retail definitely was wanting back in the markets this quarter. Kind of see that a lot of across a lot of these brokerages as well.
By the way, shout out to 1,500 people who are here live at 7:45 in the morning. Yeah, it seems like a great quarter.
5:45 for me.
Oh yeah, I forgot you're on the West Coast, right? Oh my gosh.
Yeah, I'm in mountain time. The West Coast is
Right.
even earlier. Yeah, financial services is only 4 million away from contribution profit. It's really close. Like they narrowed the gap by a ton this quarter. So last quarter, let me pull that up, sorry. Last quarter there was the contribution loss in financial services was 24 million. This quarter it's only 4 million. So next quarter they'll probably have contribution profit inside of financial services, which again,
Wow.
that'll be a full quarter ahead of what they guided, which is not surprising, but they always guide conservatively.
Yeah, this is super, super exciting. Yeah, I think honestly, Chris rounded this out at the start of whenever we started speaking. I don't care what the stock is doing. This is extremely positive. I think SoFi could have done this a bunch of different ways, and that's the thing too. There's no linear growth here. It's extremely flexible. And one of the things I said is like they could add a ton of SoFi Money members to try to boost deposits and still go after personal loans. And it seems like they're doing that. I think maybe they're keeping their Q3, I mean, Q3 or even Q4 expectations for profitability. But before they get there, they're going to have a very strong member base, lots of products, and people all over the place that are bringing in a lot of money over time. I have no like I'm a growth investor. I don't care. I don't need them to be running to profitability right now. If they see an opportunity to collect way more members at a lower customer acquisition cost.
Yeah, I think the market might be dragging it down just a little bit because maybe they wanted greater profitability, but
yeah,
when you get 584,000 members, you can wait for profitability.
It's what management was telegraphing, man. It's not that,
That's the weird part about it. They didn't say they would be profitable this quarter at all. So
yeah.
Thank you, Josh. Really appreciate the $20 dono there, man. Love you guys so much. Josh has a massive SoFi portfolio. I think it makes up like 99% of his account, which is probably at like 2.5 million today, or at least whenever it was above $10.
So one of the cool things, their presentation includes a couple extra slides that they didn't have previously. So they break down the net interest margin, which they've never done before. And they also break down the fair values of loans, which they've never done before. They're near the bottom of the presentation slides. But the NIM actually expanded So the net interest margin. So that means the amount of money that we're making off of our loans actually expanded quarter over quarter. I think that's probably a combination of the fact that deposits are taking over more of the more of the amount that we're lending out compared to warehouse lines of credit, and then also the fact that we added $3.7 billion worth of personal loans at a much higher marginal rate than what's already on the balance sheet.
Okay, so help me understand, because this is kind of where it gets out of my realm. How, if the net interest margin is expanding and you know the default rates they're assuming are going to stay the same, but yet they're discounting the fair value at a higher amount than before? Could that be a marketplace issue?
That's the discount rate. So think of it like your opportunity cost, right? So the opportunity cost of if I'm, some sort of asset manager
see.
and I want to buy $1 billion worth of loans, the opportunity cost for that, right? I could just stick that $1 billion in a 1-year treasury bill and get 5%. But now this quarter I can get 5.5%. I don't those aren't the exact numbers, right? But the T-bills went up, right? Because the rates went up.
Yeah.
And so your opportunity cost increases, and so the fair value of the loans decreases, right? So that's
because
what
it's a more
I can't
mature
remember.
because it's a more mature book
Because
of loan.
your risk-free return is higher, right? So it's
Mm.
an opportunity cost thing. So
Sure.
like so you can use your $1 billion and you can guarantee yourself 5.5% return this quarter versus 5% return last quarter, right?
Yeah.
And so because of that, the theoretical value of the loans all comes down, which is why, I mean, the fact that they still got pretty high non-interest revenue, even with the decreasing value of their book,
Yeah.
like,
I'm interested.
like,
Go ahead.
go ahead.
I was just going to say,
No,
I'm
I'm done.
interested to hear as well what their spreads on their cost of funding is. Again, I think last quarter is like 210 basis points of what they're benefiting from their deposits versus warehouse facilities. That's been expanding every quarter. It'd be really exciting if that goes up again. But
Yeah.
some people are wanting us
Well,
to
it's right
touch
there.
on Galileo before
Yeah.
the quarter gets started.
Also, yeah, okay. Also, what did I want to bring up? I wanted to bring up this. What happened to SoFi to the moon on this report? I mean, they added 100,000 more members than our highest prediction. So it's
The business is going to the moon. The stock price will eventually follow.
Yeah.
Yeah, like I can't predict the stock price ever. This is a great business. I think their survival is more guaranteed now than it was last quarter, and that's what matters.
People have to remember SoFi is still in the broad market of equities. It is a speculative play. And so for a speculative play to come in and say, I got 500,000 people to care about what we're doing and sign up for our services, that is an amazing thing. And eventually, as Jesse says in the chat, thank you, Jesse, for that $50 super chat, the market's going to figure this out, even if the stock doesn't today.
Was that? I think that was their largest member ad ever, by the way.
Yeah.
Yeah, it was.
Yeah, even higher than Q4, which was pretty exciting.
And yeah, so the tech platform reaccelerated. So last quarter we were at 77 billion, right? Or 77 million in revenue. It's back up to 87. The contribution profit is still below so it's just under 20% contribution margin. So we do want to see the margins come up, but like the fact that accelerated a lot, and accounts didn't go up that much. I don't know what that means as far as like, does that mean that we're getting more? I mean, the accounts that we have are lower than when we had lower revenue, lower revenue. So we're getting more ARPU on them, right? Like there's no more revenue per unit or per user.
Yeah.
Right.
But like
Galileo.
I wonder if that's Technisys ads or if they signed, like we'll have to wait for the call, right? But again, like that was my biggest concern after last quarter, is the fact that the tech platform had been flat for 2 straight quarters and then decreased. But now it re-accelerated back higher than it was previously before the decrease.
Right.
Let me just read this sentence really quick. We have made great progress on our strategy to sign larger, more durable clients. We talked about this in Q1. They said they want to go after bigger clients. as opposed to smaller clients. Galileo signed 5 new clients in Q2, all of which have existing installed bases, and Technisys went live with 4 new clients.
Exciting.
I have a question. This 129 million Galileo accounts. So does that mean, like I know Robinhood is a customer of Galileo. Does that mean every new Robinhood user is a Galileo user? Like, how do they measure this?
Not
129
necessarily.
million?
It could be Robinhood Cash Card people specifically, but it's also depending on. I don't know how they count the member numbers if it's for Technisys as well, because that's been confusing for me. Because they, from what I heard, whenever we bought Technisys, they had like 200 million people or something. It was something unbelievable, like larger than Galileo in terms of member numbers. And then whenever they said that they consolidated it, and the member numbers for Galileo didn't change. So
My
I don't know.
biggest gripe about all this is that it is like there's so much it's so opaque looking at the tech platform.
Yeah.
They've
Yeah.
published so
Yeah.
few numbers. Like, give us something else. Like, give us a little bit more detail. I realize you've got NDAs and you can't disclose everybody's names, but say like, this is how many Technisys core banking people there are. This is how many, cards Galileo has issued in the last quarter. This is how many payments, like in total gross payment, like they processed last quarter. Like, at least give us some big broad numbers so that you can actually have just a little bit of insight into how the tech platform's going. Because all you get is revenue, contribution profit, and total Galileo accounts, and that gives you very, very little to understand what's going on with the actual business. It's frustrating.
I agree.
Call is going to start in about 6 minutes. We have ticked back up in the pre-market. We'll see how that goes through.
3% pre-market.
Mm-hmm.
So honestly, I think my prediction that Galileo is going to add 0 new members was pretty dang close.
No, it was.
Like the thing is that from at least what I heard, that Current was not done dumping on or off of Galileo's platform at the end of that quarter.
Interesting.
Yeah, so we probably did add more members than this in terms of the 5 new clients that Galileo brought on, but it wasn't done losing the clients that we lost from Current.
So total accounts went up 3 million, but
yeah, total.
Yeah.
But we don't know if that's the total amount of new signed accounts. Or not total, sorry, but just new added accounts.
But honestly, like, this is I didn't expect it to be this good.
Yeah.
No,
Credit cards are still slow growth. They honestly are not figuring out that product.
They did say that they're going to lean into it in the second half. We'll see if that happens. They wanted to be expanding that in the second half of this year.
Referred loans is something really interesting here. Like, we keep using this platform less and less every single quarter, adding less than 3,000 new referred loans. The first quarter that we had it for even half a quarter, we added 7,600 new people, then 9,500, then 11,000, then 8,500. Now it's 2,800. If you're a Pagaya holder, I mean, I'd look into that. I don't know if they're nearly as excited to be sort of offering these loans out to their lenders, or no one's taking them, or SoFi's taking a higher percentage of the loans that are being applied for. But considering the fact that we were taking 30% last time, I'm sure that hasn't gone up to 90.
I just think funding in general has tailed off, and like in loan asset manage, like banks especially, banks are offloading all of their loans a ton, right? Like, and there's so much there are so many loans for sale to asset managers right now that they can have their pick, the pick of the litter, right?
Yes,
like,
but then why the huge ramp for Pagaya and Upstart if the marketplace is still like
I don't know,
dumpster fire?
Like, I'm so worried about I'm worried about Upstart holders because they're subprime and near prime. I get that they had that secured funding, but like, that doesn't get them even close to origination levels they had previously. Like,
Yeah.
I don't know what the market's seeing with Upstart, and maybe I'm just missing it, but like, I really, based on Lending Club's commentary from last week, like, I don't see that business reaccelerating quickly. But the stock's up, so
Yep.
so maybe I'm missing something. But yeah,
Oh, why didn't we
huge.
talk about guidance? Chris,
The
can you tell us
EBITDA
about this
guidance is
guidance here?
huge.
That's insane.
So, okay.
It is insane.
I did write, we'll do this really quick. I wrote an article about how they were absolutely sandbagging their EBITDA guidance because there was no way that they could have the EBITDA guidance that they had and say that fourth quarter was going to be profitable, right? And so, and it ended up being true. The fact that like, and that they were going to have a huge EBITDA guidance raise, which this is a, you know, like a $50 million increase when it's like a 20% increase in guidance. And again, the market doesn't care. But like the point is that you have to have something around $100 million in adjusted EBITDA to get to GAAP profitability, just because of the difference between EBITDA, the non-GAAP, you know, expenses, like especially SBC. But that's a huge raise, right? Like $50 million is a lot. So yeah, no, guidance is awesome. The revenue didn't go up much, which I didn't really expect, but it means that their margins should be higher in Q3 and especially Q4.
Yeah, they raised guidance by, according to Brad Freeman here, 21.6%.
Yeah, it's a huge guidance raise.
They beat their the EBITDA estimates by 35.9%, and they beat their own guide by 39.6%.
Yeah. They didn't give, I guess there was a question. They didn't actually break it down into Q3 and Q4. So they didn't give exact Q3 numbers, as far as I can tell, unless somebody else sees them. So they just gave second half guidance, right? Which is, I guess, one slide up from where you were before. I don't know. I'm not looking at the stream.
Is it appropriate to just think it's like a 40-60 split? Like,
yeah, I would think like $80 million in Q3 and 100 million, or maybe 105 in Q4. I think it's up one slide from where you are, Tevis.
Tevis, can you let Steve in?
Right there.
Steve, we got the earnings call in like a minute.
Yeah,
I am shocked. You guys got Hager on? Good
Yeah.
for you.
Dude, it's the morning. I can do early mornings.
So I'm doing this mobile from the car driving into the city.
happy you made
So
it.
what did everybody think?
I think it's great.
Yeah, incredible quarter. I don't know. Is there something you didn't like, Steve?
I don't want to poo-poo how strong earnings was. I was a little shocked at how much they spent on advertising and marketing. Other than that,
Steve, I think you got the
incredible
number wrong.
results.
I think you got the number wrong. I think we were looking at year
You got
over
that
year.
number wrong.
Yeah, quarter over quarter was only 7 million.
The customer acquisition cost, Tanner was saying, it actually went down quite a bit.
lot.
Quarter over quarter.
I'm going to have to read through all the numbers on the press report then, because when Amin and I were looking at it this morning, it looked like it went up quarter over quarter just on that one line item.
Well, it did, but we added 433,000 people last quarter. This quarter we added 584,000, and that was at a cost of 7 million extra.
And when you net it out, I agree with you. I was a little shocked at how much that one line item went up. Other than that, earnings were amazing, especially the guidance. And I don't know if you guys said already, but the margin's up to 17% from 14.
Yeah.
It's nuts.
And
This is really, really
if you look
exciting.
at loan originations, student loan originations went down. They haven't even kicked in yet.
Yep.
All right, call starting.
I don't hear anything.
Just kidding.
Okay.
Tanner, will you let me know so I can just turn it on?
Okay. I don't have it open. But
You sure you're sharing sound, Tevis?
Can you guys not hear this?
No, we can't hear anything.
No.
Yeah, you're not sharing sound.
Okay, hold on.
better get that going, boy. I'm gonna be so angry.
Yep.
I might drop off during the call, depending on if one of my kids wakes up.
That's all good.
We'll
we
see.
really appreciate you coming on. That's
By the way,
You
stock's
know.
at 1022 right now. It just busted 7%. Then it fell to 990. It's so volatile right now.
It
bro.
is super volatile.
That was at 10.
Well, there was a
Oh my goodness.
$2.2 million candle, or 2.2 million volume candle in the pre-market like in a single minute.
Yeah, it's gonna be a pretty volatile
Can you guys
day.
hear this?
No, we can't hear shit.
no.
You want me to share it, and then you just
No, it's okay. I can share the.
Need me, let me know.
Can you hear this?
Yeah, we got
There
it.
it
We
is.
got it.
Yep.
Today to talk about our results and recent events are Anthony Noto, CEO, and Chris LaPointe, CFO. You can find the presentation accompanying our earnings release on the investor relations section of our website. Our remarks today will include forward-looking statements that are based on our current expectations and forecasts and involve risks and uncertainties. These statements include, but are not limited to, our competitive advantage and strategy, macroeconomic conditions and outlook, future products and services, and future business and financial performance. Our actual results may differ materially from those contemplated by these forward-looking statements. Factors that could cause these results to differ materially are described in today's press release and our most recent Form 10-K as filed with the Securities and Exchange Commission, as well as our subsequent filings made with the SEC, including our upcoming Form 10-Q. Any forward-looking statements that we make on this call are based on assumptions as of today. We undertake no obligation to update these statements as a result of new information or future events. And now I'd like to turn the call over to Anthony.
Thank you, and good morning, everyone. The second quarter at SoFi marked our 9th consecutive quarter of record revenue and 4th consecutive quarter of record adjusted EBITDA. These results were bolstered by record revenue in both our technology platform business segment and our financial services business segment, which was fueled by record member additions coupled with strong monetization trends. These results, which we achieved despite market volatility and industry disruption, reflect the unique diversification of our businesses and the strong execution by our world-class team. I am incredibly excited to discuss what we've accomplished. I'm even more excited about what is in store for us over the next several quarters, as the key underlying trends in each of our segments are indicating continued momentum across the business. A few key financial achievements from the second quarter include record adjusted net revenue of $489 million, up 37% year over year. Record adjusted EBITDA of nearly $77 million, representing a 43% incremental margin and a 16% consolidated margin. At the company level, we saw an incremental GAAP net income margin of 36%, which resulted in a loss of just $48 million. At SoFi Bank, we had over $63 million of GAAP net income at a margin of 17%. From a balance sheet perspective, our unique value proposition in SoFi continues to fuel high-quality deposits that increased by $2.7 billion sequentially, and we ended the quarter with nearly $12.7 billion in deposits. Importantly, more than 90% of our consumer deposits are from sticky direct deposit members, and nearly 98% of our deposits are insured. Our cash and cash equivalents, excluding restricted cash, increased by $528 million since March 31 to $3 billion, reinforcing our strong liquidity position. We grew our tangible book value by $14 million. We remain well on track for GAAP profitability by Q4, and a few trends stand out in support of this anticipated achievement. Lending net interest income of $232 million exceeded lending directly attributable expenses of $139 million. Adjusted EBITDA of $77 million exceeded stock-based compensation expense of $76 million for the second consecutive quarter. And financial services contribution loss improved by $20 million versus Q1 2023 to a loss of just $4 million, well on its way to reaching positive contribution profit. From a member and product perspective, I would highlight the following. We added a record number of 584,000 new members in Q2 23, bringing total members to 6.2 million, up 44% year over year. Our second highest quarter ever of new products in Q2 of 847,000 brought total products to 9.4 million, up 43% year over year. Financial services products of 7.9 million at quarter end grew by 47%, while lending products of over 1.5 million were up 25% year over year. And lastly, strong growth due to the increasing word-of-mouth virality of SoFi's products, as well as our efforts to drive greater unaided brand awareness. As an example, our recent Changing the Face of Finance campaign, which is challenging society's gender bias with respect to women and personal finances, resulted in over 72 million impressions in the first 5 weeks. We have driven this growth with improving efficiency as our full suite of differentiated products and services has continued to resonate with both new and existing members. Now I'd like to spend time touching on segment level results and trends. Lending adjusted net revenue of $322 million grew 29% year over year. The personal loans business maintained its strength in the quarter as we originated a record $3.7 billion, up 51% from the $2.5 billion in Q2 22. Our underwriting model and our focus on high quality credit have resulted in dependable performance of these loans as our annualized net charge-off rate was lower quarter over quarter at 2.94%. Within student loans, we had another quarter of low origination levels, but for the first time in 3 years, we have clarity for the business as we look toward the latter half of this year. Within home loans, we nearly tripled our originations sequentially, aided by the increased capacity and capabilities via our small acquisition at the beginning of the quarter. Increased capacity and functionality allowed us to launch VA loans, helping deserving veterans find homes with exclusive rates, no origination fees, no down payments, and dedicated loan officers. We continue to fully leverage the benefits of our bank license to drive great economics in both our lending and financial services businesses. This has resulted in strong net interest income and sequential NIM expansion as lower cost deposits on our balance sheet have grown. As of the end of Q2, 50% of our loans were funded by deposits, and our $2.7 billion of new deposits raised in the quarter was essential in funding our $4.4 billion of total originations in the most cost-effective way. Our lending capacity remains robust, with over $20 billion in total capacity to fund loans and meet our liquidity needs, with $13 billion of deposits that have grown by over $2 billion a quarter, $3 billion of equity capital, and over $8 billion of warehouse capacity. Lastly, the bank contributes to strong growth in SoFi Money members, high-quality deposits, and increasing levels of spending. This has led to high average account balances, even as average spend has increased. SoFi Money members have increased nearly 47% year over year to 2.7 million accounts. Given the quality of these members with a median FICO score of 747 for our direct deposit portfolio, we see ample opportunity for cross-buy. More than 50% of newly funded SoFi Money accounts are setting up direct deposit by day 30, and this has had a significant impact on spending. Q2 annualized spend was over 2.7 times full year 2022 spend, and Q2 spend per average funded account was up 13% quarter over quarter. Within financial services, more broadly, net revenue more than tripled year over year to $98 million and grew 21% sequentially from Q1 23. This significant revenue growth is driven by 3 vectors. The first is strong member growth across SoFi Money, Invest, Credit Card, and SoFi Protect. The second is cross-buy, as the growing member base takes full advantage of our platform. And the third is monetization. Revenue per financial services product has doubled year over year to $50, driven by higher deposits and member spending levels in SoFi Money, greater AUM in SoFi Invest, and stability within SoFi Credit Card spend. We expect all 3 trends to continue their growth momentum. Despite the continued investment in customer acquisition, we have significantly improved the profitability of the financial services segment. Financial services Q2 contribution loss was just $4.3 million, which is a $20 million improvement over the $24 million loss in Q1 23 and the $44 million loss in Q4 2022. We are seeing significant improvement in unit economics, driving greater operating leverage. The improvement in variable profit per account is a result of higher monetization rates and lower customer acquisition costs due to marketing efficiency and cross. And the scale of members is driving meaningfully greater variable profit dollars than our total acquisition costs. We expect the total financial services segment variable profit to exceed our segment fixed cost in Q4, at which point we expect all 3 of our business segments to post positive contribution profit. Our strong member and product growth reflects our culture of relentless iteration across our 5 key points of differentiation. For instance, in Q2, we raised the APY 4.4%. We launched SoFi Travel in partnership with Expedia, which includes member discounts and 3% cashback rewards on bookings made with the SoFi Credit Card. SoFi Travel represents our first effort to help our members spend better, the next phase in SoFi's mission to help our members achieve financial independence. Selection is one of our key points of differentiation across our products. Earlier this month, we were the sole retail distributor of the Oddity IPO, which should be the beginning of a robust pipeline of IPOs after a long drought due to the dampened capital markets IPO activity. Despite our demand being many times oversubscribed, we were able to make an allocation to every single member who confirmed an indication of interest. The differentiation and selection by offering IPOs from Main Street at IPO prices helps drive strong impressions and bring people onto the platform. And Oddity was no exception. Marketing related to the deal drove a total of 8 million impressions, which not only bolsters the growth in new investment members and more AUM, but also increases brand awareness and member growth for the entire platform. For our technology platform, record full segment revenue of $87.6 million saw a growth of 13% level.
And dude, it doesn't matter. It's at $10.
Growth rate in technology platform revenue to accelerate by Q4 with increased contribution from new partners to the platform, along with greater product adoption among existing partners. Tech platform's overall diversified growth strategy includes growth in new vertical segments, most notably B2B partners, new products, and new geographies, as well as a focus on partners with large existing customer bases with more durable revenue streams and growth prospects. In Q2, Galileo signed 5 new clients and made significant strides against this strategy, with 100% of new signed clients bringing existing customer bases or portfolios, which drives much faster time to revenue generation compared to a startup company, along with the growing pipeline of joint opportunities selling combined Galileo and Technisys offerings into expanded customer base. Technisys saw record revenue in this quarter and continued to make strides toward continued growth, bringing 4 clients live within the quarter. We've also experienced great product uptake in new products such as our payments risk platform product, which helps reduce transaction fraud by leveraging our unique data and algorithms, as well as Connecta, our natural language AI-driven chatbot, which provides faster resolution of customer contacts and reduced contacts per customer for our partners as well as SoFi brands. I'll finish here by saying how proud I am of our team's relentless ability to not just persevere through the disruption and volatility of the financial services industry in the first half of the year, but to deliver record results driven by the very businesses that were vulnerable to that volatility in our technology platform and financial services segments. I could not feel more blessed by our great team's ability to execute, and importantly, our over 6 million members that have been so critical in making our vision of being a one-stop shop for all of your financial needs to become such an amazing reality. With that, let me turn it over to Chris for a review of the financials for the quarter and our outlook.
Thanks, Anthony. Overall, we had a great quarter with growth trends across the entire business. We achieved record revenue and adjusted EBITDA, despite operating in a rapidly evolving macro backdrop amidst notable financial services industry headwinds. I'm going to walk you through some key financial highlights for the quarter and then share some color on our financial outlook. Unless otherwise stated, I'll be referring to adjusted results for the second quarter of 2023 versus second quarter of 2022. Our GAAP consolidated income statement and all reconciliations can be found in today's earnings release and the subsequent 10-Q filing, which will be made available next week. For the quarter, top-line growth remained strong as we delivered record adjusted net revenue of $489 million, up 37% year-over-year and 6% sequentially from the first quarter's record of $460 million and above our Q2 guidance of $470 to $480 million. Adjusted EBITDA was $77 million at a 16% margin, also above the high end of our most recent guidance of $50 to $60 million and ahead of the prior record quarter. This represented 10 points of year-over-year margin improvement, demonstrating significant operating leverage across all functional expense lines. In fact, sales and marketing declined as a percentage of revenue for the 6th consecutive quarter, with marketing intensity approximately 300 basis points lower relative to Q2 2022. Overall, this resulted in a 43% incremental adjusted EBITDA margin year-over-year. Our GAAP net losses were $48 million this quarter, which is a $48 million improvement year-over-year. We saw notable year-over-year leverage in stock-based compensation, with SBC dropping to 15.5% of adjusted net revenue versus 23% in the prior year period. Incremental GAAP net income margin was 36% for the quarter, which represents further progress toward our expectation of GAAP net income profitability in Q4 of 2023. Now on to the segment level performance, where we saw strong year-over-year growth across all three segments. In lending, second quarter adjusted net revenue grew 29% year-over-year to $322 million. Results were driven by a 103% year-over-year growth in our net interest income, while non-interest income was down 30%. Growth in net interest income was driven by a 117% year-over-year increase in average interest earning assets and a 289 basis point year-over-year increase in average yields, resulting in a net interest margin of 5.74% for the quarter, which is a 50 basis point expansion year-over-year, and importantly, a 26 basis point expansion versus Q1 2023. I'd also highlight our $2.7 billion of deposit growth in the quarter compared to the $2.4 billion of net loan growth on the balance sheet period over period. With 216 basis points of cost savings between our deposits on our warehouse facilities, this has resulted in a meaningful benefit to our net interest margin and has underscored the advantage of holding loans on the balance sheet and collecting net interest income. Looking forward, we expect to maintain a very healthy net interest margin as a result of two things. First, the mix of funding will continue to move towards deposits. And second, we expect to continue to pass on benchmark rate increases for new loan originations to our weighted average coupon. On the non-interest income side, Q2 originations grew 37% year-over-year to $4.4 billion and were driven by record volumes in our personal loans business, which grew 51% year-over-year to $3.7 billion. However, student loan originations were down 1% year-over-year and home loans by 27% year-over-year, as macro factors continue to provide headwinds to these businesses. In the second quarter, we sold portions of our personal loan, student loan, and home loan portfolios. In terms of execution levels on these sales, in the personal loans business, we executed a sale at 104.1% excluding hedges and 104.5% including hedges. For student loans, we executed at 101.5% excluding hedges and north of 104% including hedges. For home loans, we executed at 101.2% excluding hedges and north of 102% including hedges. This quarter, we maintained our stringent credit
Take that, Bears.
focus on quality, which has led to a continued strong credit performance. Our personal loan borrowers' weighted average income is $164,000 with a weighted average FICO score of 745. Our student loan borrowers' weighted average income is $163,000 with a weighted average FICO of 768. Our on-balance sheet delinquency rates and charge-off rates remain healthy and are still below pre-COVID levels. Our on-balance sheet 90-day personal loan delinquency rate was 40 basis points in Q2 2023, while our annualized personal loan charge-off rate was down sequentially to 2.94%. Our on-balance sheet 90-day student loan delinquency rate was 13 basis points in Q2 2023, while our annualized student loan charge-off rate was 42 basis points. We continue to expect very healthy performance relative to broader industry levels. The lending business delivered $183 million of contribution profit at a 57% margin, up from $142 million a year ago, also a 57% margin. Shifting to our tech platform, where we delivered record net revenue of $88 million in the quarter, up 4% year-over-year and 13% sequentially. Overall, annual revenue growth was driven primarily by Galileo account growth to $129 million in total. We also signed 9 new clients across the platform. The segment delivered a contribution profit of $17 million, representing a 20% margin, which is up quarter over quarter. Notably, as we expect to see an acceleration in year-over-year technology platform segment revenue growth by Q4, we also anticipate continued margin expansion. Moving on to financial services, where net revenue of $98 million increased 223% year-over-year, with new all-time high revenue for SoFi Money and continued strong contributions from SoFi Credit Card, SoFi Invest, and Lending as a Service. Overall monetization continues to improve, with annualized revenue per product reaching $50, more than double the same prior year period and up over 9% sequentially. We reached 7.9 million financial services products in the quarter, which is up 47% year-over-year, and we continued to see strong quarterly product adds with 759,000 new products in the segment versus the prior quarter at 584,000 new adds. We hit nearly 2.7 million products in SoFi Money, 2.3 million in SoFi Invest, and 2.6 million in Relay. Contribution losses were $4 million for the quarter, which improved by over $49 million year over year and nearly $20 million sequentially as we start to see operating leverage in the segment. We continue to expect positive contribution in the segment by Q4 of 2023. Switching to our balance sheet, where we remain very well capitalized with ample cash and excess liquidity. Having SoFi Bank further reinforces our strong balance sheet and provides us with more flexibility and access to a lower cost of capital relative to alternative sources of funding. In Q2, assets grew by $3.1 billion as a result of a $528 million increase in cash and cash equivalents, highlighting our strong liquidity position and access to cash, as well as adding loans to the balance sheet given the impressive growth we continue to see in the personal loans originations. On the liability side of the balance sheet, we saw significant growth in deposits as they grew to nearly $13 billion, up $2.7 billion sequentially versus $2.7 billion in the prior quarter and $2.3 billion in Q4 of 2022. Because of this, we exited the quarter with $4 billion drawn on our $8.5 billion of warehouse facilities. In addition, in the second quarter, we extended our corporate revolver for another 5 years and upsized it to $645 million. This further highlights our strong liquidity position, particularly in the current market environment. In terms of our regulatory capital ratios, our total capital ratio of 16% as of the end of the quarter remains comfortably above the regulatory minimum. Let me finish up with guidance. Throughout the last 12 months, we have demonstrated the benefit of having a diversified, high-growth set of revenue streams, multiple cost-efficient sources of capital, a keen focus on underwriting high-quality credit, and a high degree of operating leverage as we scale the business. We expect those benefits to persist going forward, even in light of the existing macro backdrop. In the second half of the year, we expect to deliver $1.025 to $1.085 billion of adjusted net revenue and $180 to $190 million of adjusted EBITDA, with a more significant portion of the revenue and the EBITDA expected to be generated in Q4. As we move toward expected GAAP net income profitability in the fourth quarter, we expect stock-based compensation and depreciation and amortization expenses to be slightly higher than reported Q2 levels in both the third quarter and fourth quarter of the year. This guidance implies full year 2023 revenues of $1.974 to $2.034 billion, above our prior guidance of $1.955 to $2.02 billion. Our second half guidance implies full year 2023 adjusted EBITDA of $333 to $343 million, above our prior guidance of $268 to $288 million. This represents a 40 to 44% incremental adjusted EBITDA margin for the full year. Overall, we couldn't be more proud of our Q2 results and continued progress. Having delivered $489 million of adjusted net revenue and $77 million of adjusted EBITDA, we continue to make great progress against our long-term growth objectives and remain very well capitalized to continue pursuing our ultimate goal of making SoFi a top financial institution. With that, let's begin the Q&A.
Nice.
We will now open the lines for Q&A. If you would like to ask a question, please press star followed by 1 on your telephone keypad to join the question queue. Analysts will each be allowed to ask 1 question. If you'd like to ask a second question, please re-enter the queue. When preparing to ask your question, please ensure that your device is unmuted locally. Our first question comes from John Hecht from Jefferies. John, your line is now open. Please go ahead.
Hey, thank you. Thanks, guys. Good morning, and congratulations on a great quarter. Chris, you gave a few details about some sales of different categories of loans. Maybe give us a little bit more on the execution, the details on the execution of those sales.
Do so. Hey, John. So in aggregate, we ended up doing about $340 million of whole loan sales in the quarter. Our PL whole loan sale was a $50 million sale at an execution level of 104.1%, excluding hedge gains in period. and it was 104.5%, including hedge gains. As of the end of Q2, the PL book was marked at 104.1%. Our student loan sale was a $100 million sale at an execution level of 101.5%, excluding hedges, and about 104%, including hedges. At the end of Q2, the student loan book was marked at about 101.9%. But what I would say is the important thing to note here is that that $100 million sale were in-school loans with significantly lower weighted average lives than the overall portfolio, so they have lower value. However, these specific loans were sold at a higher execution than where they were marked. The remaining $190 million of sales were home loans at an execution of 101.3%, excluding hedges, and north of 102%, including hedges. And as of the end of Q2, the home loans book was marked at 89.2%. As discussed in the past, we remain very well capitalized. We raised $3.6 billion in 2021. We have access to over $8.5 billion of warehouse lines, only $4 billion of which is currently drawn. And our bank deposit base of nearly $13 billion is really growing quite nicely. Given this flexibility, we'll always maximize returns on the loans that we originate, as well as the overall firm ROE. And that's going to take different forms given the market environment that we're operating in at the time. This quarter, we ended up doing a few small sales to keep channels open, but we remain very focused on maximizing returns, which means holding these loans for a longer period of time.
Okay, that's great. Thank you for those details. Second, and maybe for Anthony, still a lot of momentum and new customer ads. Maybe talk about the channels is there any mix shift in where you're finding these customers and how you're finding the customers, and any change in characteristics of the new customers?
Yeah, thank you, John. For the last 5.5 years, our number one objective in marketing has been to build our unaided brand awareness. Unaided brand awareness is measured when you ask 100 people, when you need a financial services product, who do you think of? And when we joined the company in 2018, 2 out of 100 would say SoFi. We've had our unaided brand awareness reach high single digits. It bounces around a little bit, but it's pretty Herculean effort to go from 2% to high single digits. The top banks in the country, top 5 banks in the country, are anywhere between 20 and 30%. As we drive that unaided brand awareness, we're building trust. We're becoming a household brand name. Parallel to that, we're doing digital marketing. We're doing other forms of traditional marketing to try to optimize our customer acquisition costs and scale our customer growth, our member growth, as well as our product growth. And I think this quarter is the first quarter that I can say I feel really confident the flywheel is really working. And what I mean by that is we're seeing efficiencies in our customer acquisition costs, and those efficiencies are really more correlated with the unaided brand awareness being increased. In addition to the fact that our marketing and product teams are iterating every day through technology and content information analytics to drive those efficiencies. One of the reasons that we're going to be able to achieve contribution profitability in the financial services segment, which we're still spending a vast amount of money on acquisitions, doesn't pay back for 12 or 24 months, is because we're really nailed the unit economics and the customer acquisition cost. We're starting to feel the benefits of virality. We're starting to feel the benefits of efficiency by product. And then, of course, the cross-buying at the same time that our monetization is improving. So I wouldn't point to one specific channel or one specific effort. It's the holistic approach that we've taken over the last 5.5 years that is really starting to pay off in the quarter and as we look into Q3 as well.
Thank you. As a reminder, analysts will each be allowed one question. If you'd like to ask a second question, please return to the question queue. Our next question comes from Dan Dolev from Mizuho. Dan, your line is now open. Please go ahead.
Love Dan.
Oh, hey, Anthony. Hey, Chris. Great results. Really amazing. I do have one question only, which is I noticed that the non-interest income in lending declines this quarter. Can you give us some color on why that's going on? Thank you.
Sure. Hey, Dan. So the non-interest income declined sequentially, and that was a function of fair market value write-downs, which was due to increases in interest rates. And we also had an increase in absolute dollar amount of PL write-offs. Now, while our dollar charge-offs were up sequentially, as I mentioned in my prepared remarks, our annualized charge-off rate in the quarter for our personal loans business was 2.94%, which was down from what it was in Q1. As we've discussed, in this current market environment, we do expect net interest income to contribute more meaningfully to the lending segment revenue. That's because we're seeing a much better return by holding loans for a longer period of time and generating that net interest income versus selling or generating near-term monetization opportunities. Now, specifically speaking about the fair market value write-downs, the marks on our loans across all products ended up decreasing period over period. In the personal loans business specifically, the fair market value mark decreased from 104.3% to 104.1%, so it's down 20 basis points. This was a function of the discount rate increasing by 60 basis points to 6.1%, and that was a function of the 2-year Treasury swap rate increasing by about 69 basis points and spreads tightening by 10 basis points as a result of secondary trade observations. This was partially offset by the portfolio weighted average coupon increasing by 40 basis points to 13.6% and the conditional prepayment rate assumption decreasing by 10 basis points to 19%. The annual default rate in our assumptions in the marks remained at 4.6%, which was the same as Q1. The one thing that's important to note here is the actual realized Q2 annual default rate was 2.94%, down from the prior quarter. That means what we were actually observing in terms of losses in the quarter are 166 basis points per year, or 250 basis points over the life of the loan, below what is embedded in our current mark of 104.1%. In the student loan business, the fair market value mark decreased from 102.6% to 101.9%, so it's down 70 basis points sequentially. This was a function of a few things. First, the discount rate ended up increasing by 30 basis points to 4.4%. That was a function of the benchmark rate increasing by 50 basis points and spreads tightening by about 20 basis points. Second, the CDR embedded in the mark increased by 10 basis points to 50 basis points. And then third, the CPR embedded in the mark increased by 20 basis points to 10.6%. Collectively, these were partially offset by the portfolio weighted average coupon increasing by 10 basis points to 5%. The important thing to note here is that the actual realized Q2 annual default rate was 40 basis points. That means what we're actually observing in terms of losses are 10 basis points per year, or 50 basis points over the life of the loan, below what is embedded in the current mark of 101.9%.
Thank you. Our next question comes from Mike Perito from KBW. Mike, your line is now open. Please proceed with your question.
Hey, Anthony, Chris, good morning. Thanks for taking my question. I wanted to switch gears a little and ask a question about the balance sheet. I was just wondering, when you think about the 2H guide and the full year guide, Chris, I mean, can you maybe give us a little bit of a sense of what type of balance sheet growth you expect? I mean, the capital ratios are still fairly healthy today, but continue to move down. Is it fair to think that, you know, with the elongated hold period on some loans, there'll be some more amortization and then the balance sheet rate of growth should slow from here, even with strong originations expected to continue? Or how are you guys thinking about that?
Yeah, sure. What I would say in terms of overall growth from an asset perspective, I would expect similar growth to what we've seen over the course of the last few quarters. We are seeing an uptick, obviously, in the amortization down as a result of paydowns. And then on the liability side, we are expecting continued healthy growth from deposits. We will be able to grow this quarter over $2 billion, or we're expecting to grow over $2 billion again. So net, you could see similar growth in the balance sheet relative to what you saw this past quarter. In terms of capital ratios, as you mentioned, those remain extremely healthy in the mid-teens across the board. And we have sufficient capital to deploy.
Operator, next question.
Thank you. Our next question comes from Kevin Barker from Piper Sandler. Kevin, your line is now open. Please proceed.
Good morning. Thank you. I'd like to follow up on the NIM. Obviously, it is really strong this quarter as you continue to grow, particularly with the personal loans, you know, becoming a real driver of that and the yields that you've been seeing there. Now, as we look into, you know, the end of the year, you know, we expect, you know, student loan refis to pick up.
would you expect a little bit of pressure on the net interest margin as you transition more towards student lending versus personal lending? Or do you feel like the growth maybe could accelerate on the asset side, just given a pickup in refis from student loans coupled with momentum on the personal loan side?
Sure. What I would say in terms of Q3, we do expect NIM margins to remain very healthy, but we are taking a conservative view, and that's what's embedded in our overall guidance in the back half of the year, given potential increases in cost of funds and various pricing strategies, as well as the mix shift in our loan originations to student loan refinancings, particularly in Q4. As you know, that there's a lag between how we price our loans relative to when the Fed moves rates, given that we price to the forward curve, which impacts our cost of funds once the Fed increases. But we do anticipate being able to maintain very healthy NIM margins. As you saw, they were up sequentially to 5.74% this quarter.
Thank you, Chris.
Thank you. Our next question comes from Andrew Jeffrey from Truist. Andrew, your line is now open. Please go ahead.
Thanks. Good morning. Appreciate you taking the question. The deposit growth is super impressive and remains strong, and obviously a real source of differentiation. I wonder, Chris and/or Anthony, if you could comment just on a couple aspects of that. One, sort of the sustainability or, in fact, potential for acceleration, I think especially given the fragmentation of the banking industry and the introduction of FedNow. And just two, how do you view that very high or market high APY and the sustainability thereof as you see more competition from similarly high yielding accounts out there from other providers?
Yeah, we're super excited about the progress that we've made over the last year and a half of having the ability to set our own APY on SoFi Money, and then to benefit from those high quality deposits and lower our cost of funds on the lending side, which is really causing the whole P&L to work well together and a clear competitive advantage. As it relates to deposits, 90% of our deposits, our consumer deposits, are from direct deposit customers, which is a heck of an achievement given that we're adding $2+ billion a quarter. We want to make sure that we are a primary relationship with our members, given our strategy of building a relationship with them on their first product and building that trust and reliability. So when they need a second product, they come to SoFi. So we're going to continue to be very purposeful and focused on high quality deposits and high quality growth. We're comfortable that we can continue to add $2 billion of deposit a quarter on the back of member acquisition on SoFi Money. We're also confident that we can continue to compete with anyone on APY that's a rational company. And what I mean by that is we are very unique in that when we bring in deposits at that 4.4% APY that you get without fees, those deposits are then funding businesses that have an even higher yield against them in our origination platform. Many of the people that compete in the APY top tier that we compete in do not have that same origination platform and can't generate the same type of yield off of the deposits that we can. And so we have an advantage as it relates to being both an originator of loans and obviously a bank with the deposits that are insured up to $2 million. In addition to that, we also have the benefit of those money members coming in and buying another product that has great variable profitability, and even better when we don't pay for that customer acquisition cost. So for example, illustratively, these aren't the exact numbers. Let's say we make about $700 in variable profit on a loan, and the customer acquisition cost for that loan is also $700, which is taken out of that variable profit. If someone cross buys into that loan product for money, we acquire the money customer at less than $50, less than $25 often. They cross buy, and the profitability of that loan goes from $700 to $1,400. So there's great leverage there. We haven't even begun to leverage that type of benefit in terms of thinking about the APY. We're really excited that when rates start to decline and other banks can't maintain the level of APY that we can, how competitive we can be versus them. So we're going to maintain high quality deposit acquisition. We're going to leverage our competitive advantage to stay at the top tier of that APY and just make sure we focus on quality over quantity.
Thank you. Our next question comes from Mihir Bhatia from Bank of America. Mihir, your line is now open. Please go ahead.
Good morning, and thank you for taking my question. I wanted to
maybe go back to the discussion about financial services productivity loop for a second. I was just wondering if you could just talk a little bit more about that. Specifically, when you look at slide 7, is there a specific ratio where you expect that ratio of, financial service products to lending products stabilize around? Obviously, your products per member seems to have stabilized right now around this 1.5 mark, which, very impressive given the growth in members, but just wondering about, just the other ratios. And relatedly, if you could also just talk about the major cross-buy channels that you currently have and how you see that evolving. Thank you.
Sure. While we're growing our member base at, this quarter was 44% with a record number of member adds. While we're growing the member base so quickly, that's in the denominator, it's unlikely that the 1.5 products per member that you're using for total products and total members is going to go up. In fact, I think it's a Herculean effort that it's actually stayed stable at 1.5. Typically, if your member base, the denominator is growing that fast, it would put pressure on the quotient of 1.5. And then over time, as the member base slowed, the product growth would accelerate and that number would start to go up. We're at 1.5 today. The numerator is growing very fast. The denominator is growing very fast. I'd say I'd expect it to stay in about that range. I wouldn't expect it to start to move up until the member growth really slowed quite meaningfully, because there is a lag between when a member comes onto the platform and when they take out a second product. And so it's really significant that we're maintaining that 1.5. Over time, my hope would be that they have 3, 4, 5 products with us. Hopefully they have every product they have with us. We want that lifetime relationship to be with them for all of their needs. And so we're going to continue to not just build trust with them, but add product selection so we can be there for all of the major decisions that they make and all the days in between. As it relates to the cross-buy channels, we provide that slide in the investor deck to kind of give you a sense for the products with the highest scale and the most data are the products that are the best at driving cross-buy. So if we have a primary relationship with a SoFi Money member and we have their direct deposit, we see what bills they're paying, we see what loans they're paying, we see if they have excess cash that should be invested in vehicles outside of just yielding on the savings account. We see if they're not able to generate discretionary spending that should be invested. If they're not investing in their 20s, it's really hard for them to get to the point that they have financial independence to catch up later on. And so that primary relationship gives us really great data about their mortgage, about student loans, about budgeting, so we can help them get their money right. The Relay product is something we don't talk about that frequently because it doesn't directly drive revenue, but it's also a big contributor to cross-buy and a huge contributor on the data side. I have all of my accounts, all of my credit cards, savings account, checking accounts across my entire family connected, and I can see real time in Relay every transaction that's happening with any of my money anywhere. It not only gives me great insight on how to budget, but also gives me good insight in where there are areas of inefficiency that I can drive favorable budgetary decisions behind. Not to mention, we also get mortgages through Relay. We also get student loans through Relay, and then of course credit cards and the refinancing of personal loans.
Thank you. Our next question comes from Eugene Simuni from Towers. Eugene, your line is now open. Please go ahead.
Thank you. Good morning, guys. Congrats on strong results. Wanted to ask about student loans. Obviously, we're coming close to the end of the moratorium, so would be great to hear your latest perspective on the level of demand we can expect for refis in Q4 as you kind of staring at your specific demographic that you're targeting, so maybe more affluent customers and the level of interest rates that we are at today.
So why don't we start off by sort of giving one number and also our point of view on student loan refinancing. We're really happy for the American people and that our administration has made a decision on the outlook for student loans so families can plan accordingly. It is going to be a huge burden for many of them, and the more they know, the better they can plan for the future. We're here to help them in any way that we can. There's over 40 million Americans that still have federal student loans. Think about that number, 40 million Americans. We haven't even refinanced 1 million student loans in our history. In SoFi's entire history, we have not refinanced more than 1 million federal student loans, including private student loans. And so the opportunity in front of us starts with 40 million, and then you can break it down from there based on demographics, based on interest rate, based on term, to kind of understand the addressable market. Chris will walk you through sort of our assumptions. One of the biggest points people really need to remember is that market is very large and people have various different budgetary constraints. Some may refinance at a lower rate and therefore save based on the interest rate, and some may refinance just to lower their monthly payment. Because there's no penalty for prepaying, there's no penalty for refinancing multiple times. You have no costs, no origination fees, no fees tied to it. So if someone needs to create a little bit of cushion in their budget by going from a $500 payment a month to $250, they can do that with no consequences, because if rates do come down, they can then refinance again. If rates don't come down, but they want to pay it off in the same term, they can prepay each month more than they're supposed to. So it'll be interesting to see what happens over the next 6 months, and I'm sure there will be a battleground for many of you talking about what the outlook is. But over the next 10 years, I think it's an exciting opportunity, and we're glad to be back in the business.
Yeah, so specifically related to our H2 guidance, our outlook currently assumes that we're going to be operating at our current run rate origination levels in the student loan refinancing business until September. After September, we do believe there will be a recovery to higher levels of student loan refinancing revenue than the current trend, but we do not expect to return to pre-COVID levels in 2023.
Thank you. Our next question comes from Michael Ng from Goldman Sachs. Michael, your line is now open. Please go ahead.
Hey, good morning. Thank you very much for the question. I was just wondering if you could provide a little bit more color on your expectation that a bigger portion of the revenue and EBITDA is going to be more 4Q weighted. You know, what are some of the key assumptions around that? Is that just the student loan assumptions you just laid out? And then just as a quick follow-up, I was wondering if you just let us know if the Oddity IPO has any impact to financial services revenue and profits. If I recall, I think when you guys did the retail distribution for Rivian and Nubank, there was a little bit of an uplift there. But any thoughts there would be helpful. Thank you.
Interesting questions.
Sure. So as I mentioned in my prepared remarks, from a phasing perspective, we expect more robust revenue and EBITDA generation in Q4 versus Q3. We aren't providing detailed segment level guidance, but one thing I will say is that we expect relatively flattish Q3 revenue in our tech platform ahead of an acceleration in growth in Q4 and additional strength in the latter part of the year from our student loan refinancing business. In terms of profit trends, we're going to be front loading marketing investments with sequential EBITDA expected to be marginally above where consensus is today for Q3 at $58 million. And we expect to see more of a ramp in Q4 EBITDA and achieve GAAP profitability in Q4. Yeah, Oddity IPO.
Yeah, on Oddity IPO, that we do get fees in these IPOs. They're not that material. The Oddity IPO is a very big differentiator for our members that have invest accounts and our members that open invest accounts, in that we're the only place that you could buy that in retail at IPO prices. And we really benefit from having that unique selection and acquisition and also AUM, which then leads to revenue. So there is some direct revenue from underwriting or being a selling agent, but the bigger benefit is to growth in members and growth in AUM.
Thank you. Our next question comes from Reggie Smith from JP Morgan. Reggie, your line is now open. Please proceed.
Hey, good morning, and congrats on the quarter. Two quick questions. The first for Anthony. You talked about becoming a top 10 bank, and I was curious how you define and measure that. The second question for Chris, real quick. Appreciate the disclosure on the loan sales. I was curious on those personal related the price back to your mark. I was curious what the APR was on those. Is it similar to the broader portfolio of 13.6, or was it higher or lower? Thank you.
Sure. On top 10, it's top 10 financial institution, and it's measured by market cap.
Yep. And on the second, the portfolio that we ended up selling had a higher weighted average coupon, but a shorter duration. So net resulted in an execution level similar to where the book is marked today.
Thank you. Our next question comes from Dominic Gabriel from Oppenheimer. Dominic, your line is now open. Please go ahead.
Hey, thanks so much, and good results. I was just curious about the incremental EBITDA margin I think the revenue is similar to what we were expecting for the year, but the EBITDA margin is significantly better and above the 70-30 split that you guys usually talk about reinvestment. And then when you couple that with the stock-based comp and depreciation perhaps staying elevated, it means that there's some real expense synergies coming through in the underlying business. And I was wondering, what your feel is on investments moving forward, and if the 70-30 rule has changed, and where in the expense lines, G&A, technology, and product development, any of those buckets you could talk about where you're seeing the most leverage to really raise this incremental EBITDA margin guidance. Thanks.
Sure. Let me kick off. The first thing I'd say is our long-term view is 70-30. So as you think about 2024, definitely orient your mind around 30% incremental EBITDA margin. The world has been very uncertain this year, and that's probably one of the biggest understatements that I can make. And because the world has been uncertain, we've held back some investment going into quarters to see where revenue comes out, so that we're certain we can always deliver on EBITDA and on GAAP net income and EPS. As the quarter unfolds, we see opportunities to release some of that cushion and to spend it in acquisition. It so happens our business is doing very well. We obviously saw the first time in our history that 50% of our revenue growth year over year was actually driven by non-lending businesses. If you look at the change in the financial services segment and the change in the technology segment year over year in dollars, it was equal to the change in the non-GAAP lending revenue. So they were equal for the first time. Well, as that growth rate continues, we get a lot of operating leverage in those two segments, and it allows us to drive more to the bottom line because they're high incremental margin businesses. And in fact, FIS, financial services segment, lost $24 million in Q1 and lost only $4 million this quarter, and that's down from $44 million in Q4. So we're seeing great unit economics, and we're seeing great operating leverage covering our fixed cost in those two businesses, and that's contributing to more profitability. We have a goal this year of being GAAP profitable. Our number one goal is to make sure we're driving to our financial outcomes as it relates to the business. We want to serve our members well to do that. But based on where we've seen incremental margins throughout the year and based on the investment opportunities we have in front of us and the efficiency of those opportunities, we're going to drive more profitability in the back half of the year than we otherwise anticipated. Chris can talk to the line items that we're seeing there, but I say it's both better unit economics and the fact that we're finally exceeding our fixed costs. And then I want to revisit one question someone said about accelerating the growth. We're going to focus on quality over quantity, but I will tell you, once we achieve GAAP profitability and we cover our acquisition costs, we will have much more of a license to more aggressively spend in acquisition at that 30% level.
Yeah, so Dominic, in terms of where we're seeing the real leverage, it's really across all functional expense lines. As I noted in my prepared remarks, sales and marketing as a percentage of revenue was down 300 basis points year over year. Our technology and product development expenses as a percentage of revenue were down 200 basis points. Operations down 300 basis points, and G&A down about 800 basis points. So we're really doing a nice job of being able to achieve leverage across the entire system, and we expect that to persist going forward.
Thank you. Our next question comes from Timothy Chiodo from Credit Suisse. Timothy, your line is now open. Please go ahead.
Great, thank you. I wanted to talk a little bit about some of the new client wins that you announced for Galileo. If you could just add some context around, to the extent you can, on sizing, or if these are the sort of the majority of the programs coming over to you. You mentioned that they have existing accounts, assuming that they're relatively established programs. And also, if you could touch on where they were before, if they were with more of one of your more modern competitors or one of the more traditional competitors.
Thank you for the question on tech platform. I'm really proud of the team and the transition that we decided to make in 2022 and where we've gotten to in 2023. It wasn't an easy decision to walk away from a lot of these easy startup types of deals that we could announce on the call and in dozens of quantities, and then they would trickle in with hundreds of thousands of dollars, but a lot of distraction from our team and a lot of focus of resources given their young nature. We understood long-term that our technology is incredibly unique. and the technology stack we have with both a multi-product core that's modern in the cloud with processing that's in the cloud, in addition to some other great products that sit on top of the platform, like our payment risk platform and Connecta, that we could go to market and fight with all the competitive set against the biggest deals in the United States and LATAM. We're really encouraged by the number of requests for proposals that we're seeing from large institutions. These things take time. These are large institutions. Our sense is they're under pressure from regulators to upgrade their technology, and they also want to, modernize their technology so they can be more innovative and they can be more reactive in real time to different regulatory pressures, as well as any disruption in the industry like we saw in the first half of this year. So there's definitely sort of a tidal wave of need for new technologies, and we have that technology. So I'm really excited that we made that transition and we have that suite of products. We're not going to win every deal. I'm confident we'll win our fair share. It'll take time. In terms of the actual results, I would say we're seeing very small contributions from the new partners that we've added. It definitely was a benefit to the quarter and helped us on the upside. We're seeing still strong, steady growth from our existing partners that are doing quite well. We're obviously anniversarying losing a partner a year ago, which we made a tough decision on, but it was the right long-term decision versus the easier near-term decision. But we're now anniversarying that. And as Chris mentioned, we expect the tech revenue to be flattish in Q3 and then accelerate year to year in Q4 as we get more contribution from those new partners that are either already onboarded or that will be onboarded. And I'm really excited about 2024 when the investments that we made this year in onboarding new partners start to kick in even more. So I think it will be a slow, steady melt up in revenue over time with the acceleration on a year-to-year basis coming in the fourth quarter. Nothing to announce on the big bank side or big financial institution side. We're in conversations with every type of bank you could think of: large banks, regional banks, community banks, and then companies that are not banks but have large consumer bases that they would like to offer financial services products to, that we uniquely can do that with.
Thank you. Our next question comes from Robert Wildhack from Autonomous. Robert, your line is now open. Please proceed.
Good morning, guys. I wanted to follow up on where the current book is marked down sequentially a bit for all the reasons you discussed, Chris. Do you think that will continue to drift lower in subsequent quarters? And if so, do you think that non-interest income and lending can stay at the $100 million level you hit in the second quarter?
Yeah, let me start on that question. One thing I want to make sure people are paying attention to is what our weighted average coupon is. We're very fortunate in that we've built a sophisticated ability to test different price points against different credit backdrops. And we've been really successful in passing on higher rates in our loans as benchmark rates have gone. Now, obviously, there are a number of factors beyond weighted average coupon, including spread and the benchmark rates and prepayments and defaults on our cost of funds, and I'll let Chris talk through that. But people really should pay attention to what are we doing on weighted average coupon, and how is that providing us some leverage uniquely in the marketplace versus competitors as we still gain a significant amount of volume. I'll let Chris talk through the other components of it.
Yeah, so I already went through the details of where the marks are and how they changed quarter over quarter. In terms of how we're thinking about or what we expect going into Q3 in the back half of the year, it's going to be dependent on what happens in the market. It's going to depend on what happens with rates. It's going to depend on what happens with charge-offs, prepayments, et cetera. We mark to market the book every single month, and we take into consideration all of the inputs that I outlined in what drove the changes quarter over quarter. So it's highly market dependent. What I would say is in this type of environment, given where rates are and the returns that we're generating on our loans by holding them, we would expect net interest income to be a much larger portion of the overall revenue pie for the lending segment. But that could change depending on market environment.
And hopefully it's clear by our reported numbers how the yield we're getting on the loans is greater than the price people would be willing to pay. That should be obvious from the financials at this point.
Thank you. I'll now turn it over to Anthony for any closing remarks.
Thank you. People often ask me how. How did SoFi get to such an unprecedented point in being a digital one-stop shop for financial services? How did SoFi get to the point that so many companies over the last 5 years have endeavored to reach, while others now say it's their aspiration today? How did SoFi do what so many others strive to do? answer to what contributes to our success is simple. It's our team. It's our people, the people of SoFi that wake up every day focused on achieving our mission and building our culture so that we can change the lives of millions of people. And someday, hundreds of millions of people. Yes, that is hundreds of millions of people. Make no mistake about it, no company, no leader, no team has greater ambition or aspirations than we do at SoFi. No company is further along that journey than SoFi, and it's on me to ensure we win every second of every minute of every hour of every day. Thank you for your time today, and I look forward to addressing you again next quarter.
Goodbye.
Hoorah, ladies and gentlemen.
Everybody. Thanks very much for joining. You may now disconnect your lines. Have
Leave this.
So I need to go soon. I just want to say two things. Amazing quarter, amazing call. Biggest words in there were buy and in. Noto said profitable by Q4. LaPointe said profitable in Q4. They are firing on all cylinders.
Stock is at 1040, baby.
Can't wait for SoFi Weekly this week. Talk to you guys later.
See you, Steve.
See you later, Steve. Thank you.
Is Chris here as well, or is
He might have. Yeah, he's probably with his kid.
he might just be listening?
Oh no, he's there. He's there.
I've got a little guy with me, so I don't know how much I'll be able to contribute.
All right. Guys.
All right. So first of all, we're gonna do our raw thoughts now at 9:30. These guys are doing the market open with me, so they're staying with me.
I can't.
Tanner, you can't.
I'll do it.
Tevis will do the market open. We'll talk about a bunch of stuff in the market. We'll analyze SoFi. But let's start it off. What were you guys' raw thoughts after you heard the earnings call? Let's start with Tevis, then Tanner. Tevis, go ahead.
Yeah, I love that JPM question. Even though it was a stupid question because Anthony Noto had answered it before in terms of how he judged the top 10. Just to hear Anthony Noto reiterate it to JP Morgan, a top 10 financial institution, was just it was nice. It was nice. But yeah, overall, I think that I'm going to have to dive into a lot of the specific questions around the loan sales and around like coupon rates and all that stuff that I don't understand super well. I think the excitement was definitely up. You could hear it in their voices and how they were answering the questions. They were upbeat, and that definitely reflects in their numbers and just how they're looking at the business. Noto was talking about like once we achieve profitability, we're going to be more aggressive. The market's been conservative, and talking about like acquisitions for 2024, so on and so forth. He highlighted Relay products per member is going to go up as we grow member base. Lots of really good things here. 90% of deposits are from direct deposit customers.
98% insured. Don't forget about that.
98% insured with their 2 million FDIC insurance. The annual default rate is the same as Q1. So, I took a lot of notes. They're all scattered at the moment. I have to sort of comb through the actual press release with the notes from the call in mind. Yeah. But just raw thoughts, I think that, and even Anthony Noto capping it off with congratulating the team. Like, I think that was a good, it sounded a little markety in my mind, but that's, people ask me why. Like, it sounded like he was giving like a TED talk or something.
Man, he's literally like a sergeant at war. Okay. Like used to literally be a sergeant. Okay. He is the guy to stand at the front of the helm and say, people always 100%. No, bring me that uniform style approach, man. This guy is an I honestly believe he wakes up to make this company better every single day. It's his life's mission right now.
He said that at the end. He was like, every minute of every day of every hour, it's my job to move the company.
And he believes it. 100% he believes it.
Yeah, and we know that he's like personally not only has skin in the game, but he sees this company as like his legacy, as his imprint onto the world. It's not him working as an analyst at Goldman. It's not him, working at Twitter or at the NFL. It's this, and it's turning this company around, joining at a time when the company was not in a great spot, but it had raw potential, and getting them there through pure execution alone. And that's what we're all here for. And really love to see, it gets old after a while, but it really doesn't. You know, I was telling somebody in the chat, like, this is like Christmas for me, because I make, you know, along with you guys, like we make SoFi content 2 to 3 times a week. And opportunities like this, when we can hear from management that are so rare, we get one CNBC interview or, you know, one Bloomberg article or one tweet every now and again. It is really reinvigorating to hear management be as excited about the future of the business as you are. And you can just hear it in their voice and in everything that they say and how they talk about the business. So that's really positive.
They
Stock's
said
at 1049 in the pre-market, 1050.
1050.
Yeah,
love it, love it. They said that the basis point spread on deposits versus warehouse facilities went up again, a very small amount this time. I think it was 210 last quarter. It's 216 this quarter. I like, yeah, I don't know. Very, very exciting. I wanted to bring up that point where they were talking about how multiple people brought up this seemingly is going to be the next bear thesis. There always is a new one. How they said there was a 20 basis point drop in fair value on the loan portfolio. But what Noto and Chris Lapointe wanted to bring up multiple times is this is offset by a 40 basis point increase on their coupon rate, which coupon rate is just like don't get it that confused, because it's really just a different wording for the interest rate that people are paying. It's what they're bringing on. So, you know, the coupon rate I think is 13.6%. It's massive, especially considering that the default rates, the expected default rates, didn't climb at all. So, yeah. Now, yeah, I don't know.
Chris, go ahead. You got something to say?
Well, I was just going to say, I think they did a much better job than they've done in the past of being really, really clear and precise on exactly how the fair values moved, exactly what factors go into them. I think that they've realized that a lot of these analysts are kind of harping on it. And so like Chris Lapointe was so ready to answer that question with all the details that they needed in order to figure it out, right? Like it's been such a sticking point and talking point for the last 3 months that their homework was done and he was ready to answer that question. And I think he did a good job, like a good enough job to say, like, where at least whether or not like the analysts believe them or not is something different, but you can't call into question like how they did it at this point, right? Like there's clarity there, which I think is something that they haven't always had in the past. And then the other thing is they did kind of what so after last quarter I said, hey, they should just sell a small tranche of loans so that like they can justify the fair values. And they did only sell $50 million worth of personal loans, which is tiny, you know, when considering you've got, you know, something like $12 billion on the loans. $50 million of loans is not very much, but they did it, right? They just sold a little bit to say, hey, look, we can actually sell these, and they are at the marks.
Someone's excited that SoFi's $10.72 right now.
That's right, he is.
Yeah, they also brought up they did $100 million student loan sale. The loans, although the loans were a lower coupon rate than their overall book value, or sorry, their overall coupon rate for their book for the portfolio. Loans that were sold at higher levels than what was marked at fair value for the loans. They saw 104 to 105% gain on sale margin. I mean, I don't know if it, like, in terms of how bad the marketplace is right now, I don't know if it gets better than that.
And I also noticed that there were more analysts this time around. I mean, there's been progressively like more and more analysts just covering the stock and on these calls asking questions. I mean, we heard from the usual suspects like the Truists, the JPMs, the Oppenheimers, the Jefferies, the Mizuhos of the world. But it seemed as though there were a couple of others as well that I hadn't heard from before, or that, you know, they weren't as forefront.
Said another $2 billion for deposits next quarter, so that'll be the expectations going forward, I think. But as you can see from this quarter, just because they say one thing, obviously they blew it out of the water. So that's really good.
Travis, you can share my screen and we can see the real time movement of this.
You can only do that on Robinhood, eh?
Only on Robinhood, eh? One thing I was going to bring up is so they asked them about sales and marketing. So they spent $7 million more than last quarter on sales and marketing. And one of the unique things Noto said was not only is he seeing more efficiencies on the product side, marketing side, analytics side, the cross-selling, upselling side, but he said a very specific quote that says, "We are starting to see the flywheel take effect."
Yeah.
What were your guys' thoughts on him?
Well, he
talking about that?
also so let me just touch on another interesting quote that he said. Amit Chris Lapointe said in his remarks, sales and marketing, and again in the earnings questions, sales and marketing spend, while it might be up on aggregate, has declined as a percentage of revenue for the 6th quarter in a row now. That is not nothing.
Well,
right.
The funny thing, because I've always kind of under my breath have bashed management because they were kind of doing this thing where they were saying, "Oh, you know, yeah, we're having the flywheel. We're bringing people. If you're bringing people onto financial services through Relay and SoFi Money rather than personal loans directly, your customer acquisition costs shouldn't continue to climb, and those should be the lower CAC cost products that you bring people onto." And they said this. Noto said this is the first quarter that I truly feel like the flywheel is actually working, and no wonder, because the CAC cost did fall like 30 something percent or whatever it is. So, or yeah, about a minus 25%, but it depends on how you're looking at it. But anyway, that is really exciting. If we can start to bring down these CAC costs and get people on through Relay, which it could be Relay that's actually doing this. Like Noto was touching on how he's using it. If people are putting all their information on and SoFi knows how to sell to you better, they won't have to, spend as much doing, I don't know, TV commercials or stuff like this. They can just simply say, "Hey, you know what? You already have a personal loan at Bank of America at a higher rate, and we can offer it to you for lower. Here you go," and people will take it.
Yep.
It should get better. That should get better. 584,000 members is something that we need to not forget. Like, I know there's a lot of numbers here, but 584,000 members was 100,000 more members than any of us suspected.
Yep.
That is crazy. That is crazy.
And for 7 million more bucks to get 100,000 more people than we expected is nothing. I mean, like
nothing.
But yeah, I think the other thing, when it's the student loan question, they said we don't think it's going to get to pre-COVID levels this year, but we do think by September, October, that's when we're going to see higher origination. So Q3 likely not going to get student loan acceleration, but Q4 towards the back of the year.
Same thing for Galileo, right? They said the revenue and margins are expected to expand in Q4 and margins. That means every dollar that we get, which they're expecting more, is going to be worth more on the other side. That's crazy. That like, these are all really, really good signs, and they seem to just be hitting it on every side. And whenever we do have a sort of lackluster technology platform quarter for the last 2 quarters where it's been slower, other parts of the business have been able to pick up that slack, and that's why SoFi deserves a higher premium at over $10.80, is because of the diversification.
Yeah, and one of the things that I also really liked was in response to the Jeffries question. I don't think this gets talked about nearly enough, because Anthony Noto touched on the unaided brand awareness, and it's something that is the catalyst, or is the, let's say, foundational infrastructure layer for all of their net new member additions. He said unaided brand awareness in 2018 was about 2%. And right now it's high single digits. So assuming 8%, 9%, like that is a multiple expansion in unaided brand awareness. That means that, people just know the name SoFi without necessarily marketing or campaigns or any promotional advertising. He also mentioned the top 5 banks in the country are around 30% unaided brand awareness. And I think that brand awareness, as the company expands and as the company increases their APOI, as they, have these different offerings, even word of mouth is going to be really important for SoFi going forward, as we expect these member additions to accelerate in future quarters.
Especially if you've got a good experience with them. Like, if you have a good experience and you tell your homies about them, like, and they're your age. Because I would imagine those top 5 are Bank of America, Wells Fargo, JP Morgan. And then what are the other 2 that have that huge awareness?
Citi,
right? Yeah. So if SoFi gets up in there, man, this is, I mean, for the whatever the stock is today is whatever, but for the long term, everything seems to be in check. There is nothing in this call. There's no number we can point to that's like, oh, this is really bad. Nothing seems to be there. Increased stock-based compensation a little. Some of the net interest margins, I know those guys were asking a lot about those, but it seems like they had really good prepared responses for those since they knew that was coming.
I can't believe, like, there's some numbers that didn't excite me. Like the amount of new student loans was kind of low, and maybe I shouldn't have been expecting as much as I did, but whatever. But then you have stuff like personal loans being at 3.7 billion.
That's insane.
Guys, that's so much more. That's so much more.
It's 800 million more. Almost a billion more.
Yeah, quarter over quarter.
Yeah.
Yeah, like that's a lot. That's a lot at higher coupon rates, at similar default rates expected. Yeah. I don't know. The average total loan balance though did go down, which was kind of exciting. It means more it's a higher audience, right? Less, I guess, less concentration per member.
Yeah, this is a good point. After these results, remember, there's going to be analyst upgrades or analyst downgrades, however you want to see it. But those are probably going to start trickling in this week, as early as later today. I expect Dan Dolov at Mizuho. I expect Truist to be the first ones, and then we'll see where we go from there. But this is just, it adds more momentum as these analyst upgrades come in as well to just the short-term stock price.
So yeah.
So one thing real
Go ahead.
quick, if I were to say that there's a risk involved in the next 3 to 6 months, it's that SoFi is getting close to they're getting close to the capital ratios to their minimum capital ratio. So they can only continue to load their loan book like this for another quarter or two before they're going to have to start selling much more than $50 million in loans. And so if there is a bear case to be made, and the people who probably will make a bear case will say stuff like the capital ratios are going lower, they're accelerating into a brick wall where they won't be able to sell their loans, right? And that is a risk. Like, I think it's important to acknowledge it. And we'll have to see how the market plays out, right? There is, there's still risk involved in that. But in general, management's always made really prudent decisions. And I can't imagine that they're accelerating like they are up to $3.7 billion in personal loans if they didn't have high visibility into the credit markets and confidence that they're able to offload loans at the rate they're able to originate them if required. That's just my opinion.
Yeah, I mean, they sold loans for profits. And so if they're able to rewrite loans at a higher rate, then this is going to be good. And then also, the amount of new SoFi Money members of 280,000 new SoFi Money members, the deposits that we are probably going to see from those members hasn't even happened yet. You know what I mean? It'll take people time to actually sign up. There's a 30-day window where 50% of those people will sign up for direct deposit and then wait for those deposits to trickle in. So there could be a little, I don't know. It seems like they're kind of hiding in the bomb shelter and trying to survive with their amount of rations and outlive the storm of how bad the marketplace is, which according to Lending Club might be like Q1 of 2024 or something, when this gets a little bit more less competitive.
You know what's interesting? You know how much people don't care about SoFi versus Robinhood? There was 0 questions asked about SoFi Invest. Literally none of the analysts give a shit about it. So you're right on that, Tanner. I mean, no one cares about Invest.
Well, they did double their amount of new ads, 100,000 new SoFi Invest people. The highest quarter we've ever seen was 360,000. Crazy. SoFi, 100% of my portfolio. Jeez.
All right, I'm going to hop off, guys. Thank you so much for having me.
Thank you, Chris.
Thanks, Chris. Appreciate you.
Have a great one.
Thank you.
Enjoy the market open. Should be fun. Hopefully not like last time market open.
I wasn't on last time, so it won't be like last time. Amit finally has somebody to rein him in on all this stupid shit he says.
No, why did the last time when we were way up in pre-market and then it tanked in the first 5 minutes?
Yeah.
The stock price, that is.
Yeah.
Okay, see you guys.
See you, man. Really quick, if I could, for the last 5 minutes that I'm on, I just wanted to say, in terms of actual negatives, we did increase stock-based compensation. We did, get into lower net losses for now. The total net revenue increased, but not nearly as fast as, like, for example, the amount of new members that we brought on or these sorts of things. But they are like that's the problem, right? Is like even to break even on a client on SoFi, which is going to get a lot shorter, by the way. Like we thought it was 18 months before. Now I could probably do the math on this. It'll be a lot less. I can break that down in a second. But because the CAC costs have gone down so much, the actual break even on a client will have gotten a lot shorter, which means we can actually put more into sales and marketing, hoping for a faster return. Like that chart that I used to do versus like facing this company versus Cash App or Nubank is going to get a lot more competitive. But that being said, the average revenue per user dropped a lot just because how many new members we added versus how much the revenue actually did go up. But those are usually trailing events.
Yeah, Mitt and I are going to do market open. Tanner, I think, has to drop because he has to go to work.
I'm buying a house. I'm going for the final paperwork right today. So
wow,
congratulations, man.
Tomorrow,
awesome.
a house is going to be under my name.
Wow.
It's all those donations from Jesse Dow, undoubtedly.
Yeah, Jesse Dow helped fund the purchase. He donated a house to me. So
what stocks did you sell to buy this house?
Some, definitely some.
That's awesome,
Yeah.
man. That's great.
If you are watching on Tanner's channel and you want to stay for market open, then pivot to either.
I think you'll have to redo the live stream.
Are we redoing the live stream, Mitt?
No, just leave it open.
Oh,
just leave it open.
Tanner, you'll just get more views from.
Yeah. Stay here, guys. Stay here. I'll see you guys later.
See you, Tanner.
All right, bye.
Okay, so I do have a serious question. Okay.
Okay.
Very serious question. We can.
Hold on. First of all, are we giving this mofo more views? He got like half the donations on this call.
Did he?
He's
the SoFi guy, bro. He's gonna get it.
Yeah, he had to sell stocks to buy his house, so we can throw him one.
That's true. Okay, why is this? Okay, it's this way. Okay, so let's just test real quick. When I share my screen, when I share Webull, let's just see what it looks like. It should look fine.
All right, we got to talk about Palantir too, because I don't know why that's up.
Share the screen. Okay, yeah, that's perfect. Okay, so I do have a serious question before we have 6 minutes until the market open. Why didn't the Oppenheimer guy ask about the nuclear bombs and like, because he's from Oppenheimer?
I can and I will kick you from.
Why? Like, I'm so good, bro. They said from Oppenheimer. Dude's like,
I just muted him. See, he's still talking. Are you done?
This guy. Okay. All right. So welcome to the Market Edition. Market Open Edition. This is Tevis. Tevis was on last time. I think you were on 2 times. One time was without the SoFi earnings, and you were here. So let's talk about Palantir. Tevis, do you own some Palantir?
I do own some Palantir. Yeah.
What did you think of Dan Ives raising the price target to $25?
Man, Dan Ives is he has his finger on the pulse, man. Like he had Tesla. I think he called Meta too a bunch of times. Nvidia, it was a big one of his. I like Dan. He's definitely like one of those iconic bullish figures on CNBC, along with Tom Lee, and a couple of others out there. So $25 price target, I think that is definitely positive. Calling it the Messi of AI, I think he called what was it? That other company?
C3, the LeBron of AI.
C3, the LeBron of AI. Like, dude, come on. Like, okay. But I think the message was solid that Palantir is just now getting ready for prime time, and it's not really the primary stock that people or a company that people think of when they think of AI, right? They jump to AMD, they jump to Nvidia, they jump to, I don't know, maybe Tesla, or they jump to like this whole GPT conversation, but they don't really think of Palantir. I don't necessarily know how much that's going to manifest. I mean, that's all like execution risk based. I do think that Palantir is short-term overbought. It's
yeah, no, I agree. Yeah.
But I think that long-term, if they can execute, then it's a solid company. I mean, the market cap cuts both ways, right? Like, what are they at? 40 billion, something like that.
Yeah.
You know, at that market cap, you could argue that, holy crap, this company is super overvalued. You could also argue that, well, you know, compare it to Nvidia or AMD or any of these other players, and they're hundreds of billions of dollars of market cap. So, you know, we still have room to run.
How do you feel overall about the market? We got 3 minutes till the open in terms of the S&P 500 trading 20 times next year earnings. Do you feel like we're overbought, or do you think we're in a new bull market and the macro can support the valuations we have right now, given earnings have been pretty amazing for most companies?
So that's the first thing, right? Earnings have been amazing for most companies. Economy on a macro has held up fairly decently. Even Fed members are now saying that, you know, we're in for a soft landing. I think the Fed sort of overplayed their hand with regards to raises, but it really depends on them. Like, if they come out and do something stupid towards the end of the year, like raise again, then they could tip the scale to make it more risky. But right now, it seems like most investors who, by and large, had money on the sidelines, large amounts on the sidelines, collecting their 4%, you know, on treasuries or whatnot, or even on high yield savings account. And, you know, like SoFi, for example, offers 4.4%. You know, now they're seeing that like there is less uncertainty over the second half of 23 and the first half of 24. These companies are doing well. You know, all the FANGs basically so far, all the FANGs have like beaten. I think Microsoft beat by a big margin. You know, Facebook freaking crushed it, and Google crushed it. So, you know, that's a solid indicator, right? Because these were companies that were laying people off not 6 months ago, right? So I would urge caution, but I'm cautiously optimistic. I've used that term before, and I think it's applicable now again.
Yeah, no, it's exciting. It's really exciting, especially with PCE last Friday as well coming in low. I mean, I think there's a little bit of reacceleration on inflation that's happening. It's just likely we can't go below 2%. I mean, that would be really surprising. True inflation right now has us at 2.25. We were at 2.5 on Friday, so we're going down a little bit. So we'll see how bad it turns out. But yeah, I think you know, that last rate hike, it was necessary for the Fed to do just to appease them, but more likely than not, if numbers go the right way, we should get a pause for the rest of the year. And if that's the case, cuts in the first quarter of 2024, and we're off to the races. And we'll see what happens to that, but it should be okay. Do you hold any NVIDIA?
I do not hold any NVIDIA, no.
Okay, and Tesla is your biggest position by far.
So yes, on the Tesla point, yes, we are dillies, and we are talking about Palantir because this is now the market open and no longer the SoFi earnings, unlike the title of this video would suggest.
Yeah. All right. We got 30 seconds. So what happens here is that on the last couple seconds, we ring the bell. We open the market. We're going to go through all these stocks, and then I'm going to get Tevis's perspective on a bunch of stocks. If you guys have any questions on stocks, we have a special guest with us, Tevis, today. If you're watching from Tevis's channel, then you're going to continue to listen to the guy you subscribe to talk about a bunch of stocks, and we'll see where it goes. All right, here we go. It's July 31st, 2023. 5, 4, 3, 2, 1. The stock market in the United States of America is now open. Wake your ass up. The market is now open. Here we go. What do we have? Let's go to SoFi first, starting it off. It was up 12% in the pre-markets, now 10.59, up 10% after earnings. Not getting sold off yet. It's really early, so let's give it a couple of minutes. But SoFi right now at 12%, not bad. Really amazing gain from an amazing quarter. Tesla at 267, Enphase at 152, recovering down a little bit, but recovering from being at 140 from a couple of days ago. Palantir at 1845. So Palantir was at 19, goes down to 1848. It's important to remember Palantir was up 5% or 3% after hours on Friday, where it ended around 1841. So it's still up from Friday's after hour earnings, but it is down from 1909, which we were at in the pre-market. SPY at 457, Roku at 91. This one was up 30%. This big Kathy stock on Friday. So really good job for Kathy. AMD 113, Unity at 46, Meta at 323. Meta continuing to absolutely smash big tech earnings. They seem like one of the companies that is still kind of cheap when you look at all of big tech, given what they've been able to do. A lot of big losses on Reality Labs and some of their other product versions.
Fuck Reality Labs, man. Look at SoFi, 17% up, over $11.
Here we go.
Reality Labs.
Wow! Wow! Oh my goodness. Oh my goodness. Oh, it's just so big. It's so big. You did a good job correcting me when I was talking about Meta because I moved on because I didn't think SoFi would blast to 11. Woo! Okay, and Pouncer's at 1852, Tesla's 257, Meta 2323. Let's check on Google real quick, then we'll go back to SoFi. Google maintaining 133, SoFi at $11. And all right, so Tevis, what is your reaction? Why do you think the market's buying the stock?
Obviously, they watched our coverage. I want to take all of the credit and put it on the SoFi Weekly podcast because when we started the coverage, it was negative 1% in pre-market, and by the end of our coverage, it's up 20%. So you're welcome, mofos. Like and subscribe for
Now,
more.
yes, please subscribe to Tevis. This might also be helping fintech. So PayPal in general, 75. Yeah. That's amazing. I don't think we've hit 75 in a while. I think.
Well, it really helps that the market is just having a green day overall. It seems like if the market was like macro red and everything was red, you would not see 20% on SoFi. It would just be like sold off in a basket, you know?
Yeah, I agree. Hood is at 1279. Square is up at $80. Hindenburg, they probably got out of their short, but it is above where Hindenburg said to short it at. It took a couple months to recover, but Square is there, PayPal is there, and SoFi 1151. Tevis,
rich.
This is crazy.
Palantir up 6% as well. Nice.
Palantir's up 6%.
Yeah.
It's at 19. Oh my god, 1887.
1887.
I'm going to put Tevis's channel in the chat on my chat for those that are asking for it. So let me put that there. But okay, so let's talk a little bit more about SoFi at 11:30. At what point do you think the bigger banks, the JP Morgans and those guys, are going to have to there's a $14 price target and an $11 price target. Those are the highs. At what point do you think the institutions just be like, you know what, we got to give it a higher upgrade?
You know, I think that at this point, you're going to see if we can maintain above a double digit close, like if we can maintain above 10.50, 11, whatever, I think that more analysts, you're going to see them raising their price targets into double digits. So that's going to be the first, because right now there's maybe one, there's maybe two, and it's like the Truist, it's like the Mizuhos, the ones that are really bullish on SoFi by and large, like the ride or dies. You're going to see more people like maybe Oppenheimer, maybe some of these other names, not the Wedbushes yet, but some of these other names are going to be raising their price targets from 8. They're going to make it maybe 10 or maybe like 11, right? Or maybe even like 9.50 or something like that. And it's just going to raise the tide for all analysts out there in terms of what is that median or average price target for SoFi, right? So that's something definitely to look forward to as a result of this earnings. And we can see that manifesting as early as maybe later today when the first raises come in.
Yeah, no, I agree. So we're seeing it decline just a little bit now, still up 16%. There is a 15% short interest for those that don't know. So about 123 million shares are being shorted for this company. So at some point, the shorts are either going to cover, they're going to double down on their shorts. And with a quarter like this, if you're new joining, the quarter was phenomenal. I mean, we could not have asked for better numbers. Maybe something here or there, but top line numbers amazing. So if you're short right now, you really got to be betting that next quarter there's going to be something bad. There's going to be some macro event for you to get out of your short or to get some profit on it. But I think the far majority of shorts are like, maybe this isn't the best short in the market. And we might see some covering on that end as well.
Yeah.
All right.
Or they're just going to double down, right? Like I can see, I'm not saying about retail. I'm saying about institutions. Like if JP Morgan comes out and downgrades this, if Wedbush comes out and they say, hey, we reiterated our sell, whatever, Bank of America comes out and downgrades it. I think that there's going to be a large number and more importantly, a growing number of the retail community as a result of, this pod and just FinTwit in general, that is going to see that for the bullshit that it really is. But, by and large, stocks, are affected by analyst price target downgrades. And so that might take the wind out of the sails a little bit. But I think that will be offset somewhat by bullish analysts raising their price targets. I can see Truist and Mizuho raising their price targets as early as the end of day.
Correct. And those asking for Wyndham Capital, thank you for that $10 super chat. We don't know about them yet. Management didn't talk about it. We have to go through the 10K. So still no analysis on how much we paid for that. Palantir now at $19. I think the reason Palantir, it just fell to 1888. I think the reason Palantir was up, quite honestly, is because of that Dan Ives report. I think he has a big influence in the community, in the investing community. And yeah, the macro is good, but I don't think a stock pushes this heavily unless there's a really big report that gets people to think more nicely of it. And I think Dan Ives does that. SoFi now falling just below 11, now at $11. I think the big question is now, can it maintain this hold? Because even if it closes at 1050, I think we would all be happy. If we can consolidate at 1050 for the next couple of weeks and then maybe make the next leg up.
One thing I want to urge for the 1,800, 1,900 people in this room. This is a high for 2023, okay? This is something that we have not seen these levels in SoFi in all of 2023. And past that 1050 range, it's completely uncharted territory for the past year. So keep this in mind. If it draws back, all that matters is that we form higher highs and we can build on that momentum going forward. It doesn't necessarily need to be at, if it peaked at 1150, it needs to close at 1150 or higher, right? Because we are just breaking new ground. And that's the important part, is closing at higher highs consistently. That's how we build a very strong foundation, because what you don't want is this super, super high run up, and then it gives it all back in a matter of days. And it's a very artificial sort of run that encourages a lot of trading and a lot of profit taking and a lot of options in general. So you want the sustainable moves up. Those take days, weeks, months, sometimes years to form. So the higher highs is what's important here, and that's what you should be caring for, not necessarily that it hit 1150 and it came back to 1110. And look at what it closes at today is my point.
I agree. SoFi now at $11.23. All right, Tevis, while you're here, let me get some of your thoughts on some of the other companies we have. Microsoft, any thoughts on them? And the second question is, Microsoft or Google next 10 years, which one are you holding? Saw some cloud growth decline a little bit, but that, they ran up to all-time highs before they sold off their earnings.
Microsoft, Microsoft is like one of those companies that they're not the flashiest of the fangs, but they are consistent performers, man. Like, they have so many diverse business streams and they're just consistently outperforming, beating their metrics, and just a juggernaut completely. Ever since Nadella sort of came into his position, the stock has delivered brilliant shareholder returns. So you can't underestimate Microsoft. I think that if you're talking about Microsoft or Google for the next decade, you're really talking about who is going to be the winner in AI. I don't necessarily have a horse in that race, so to speak. I will say though, I don't think you can discount Google. They have a gigantic data set and an established brand, and I definitely think that they are going to be a strong contender in the AI race, even though they might have had a later start than OpenAI.
Yeah, I agree. And I think we realized ChatGPT is not taking Google's lunch. I mean, search is not going anywhere. And if anything, AI is going to enhance Google. So Google will be my pick as well. Palantir at $19.15, up 7.55%. Tevis, do you think this is retail FOMOing in, or do you think these are toots?
Palantir?
Yeah. I think it's retail. FOMOing.
Dude, go on the 1 hour chart for Palantir. It's fucking stupid. There's not been a red candle in the 1 hour chart for so long.
Wow, look at that.
It just looks really nice.
It's so big. It's just so big.
It's something Amit has never heard in his life. But yeah, I think Palantir at this point is going to be drawn up and carried by the macro, right? Dude, this is, in December of 2021 or in January of 2022, you could have thrown a dart at a dartboard and that stock would have fallen over the next year. And I think that this period is the period when, people are starting to realize that you could probably throw a dart at a dartboard and it's probably going to go up over the next 12 months, just on a macro basis. I know people are still going to be bearish
I mean,
regardless.
Upstart is up 360%. Like,
You got to
fucking
get that guy
Upstart.
back on CNBC that didn't know what the fuck they did at all.
Insane.
Like I just think that so much is driven by the macro. So much is driven by this basket buying and selling by institutions that you don't necessarily know if it's the stock or if it's the macro, right? And so I do think that it is. There is less uncertainty now than there was 3 months ago, and there was less uncertainty 3 months ago than there was 6 months ago. So as that uncertainty gets lower and lower, then the market's going to go higher. Just my super basic caveman take, right?
Yeah, no, I agree. SoFi now up 19.2%, $11.37. Palantir at 19.22. Here's another catalyst for Palantir I think people are not thinking about at all. When NVIDIA reports earnings and they crush it on their 60% guidance raise, because they're not going to miss when they just raised last quarter, NVIDIA is going to go up. I mean, most price targets are at 540 for NVIDIA. You can imagine NVIDIA
That's
maybe
where I'm
touching
going to push
500.
back. That's where I'm going to push back. I think NVIDIA, it depends, right? They can definitely go up, but I think that NVIDIA is absolutely priced to perfection.
But if they crush it on earnings, do you think market's going to give them a little bit more premium or no?
Depends how much they crush it. But I think if they crush on earnings, if they do a triple beat, if they say AI a whole bunch of times, I think they're priced to perfection. And I think that, NVIDIA being at is it at all-time highs? Something like that.
Close to it, yeah.
It's just, yeah, I think it's going to be hard for NVIDIA to just run up a lot more.
But yeah, we'll see. Palantir now at 1938, just crushing it. The thing is, if NVIDIA does run, all AI stocks are running, and that's another catalyst. If Palantir's earnings are well, that is gonna do good for them. Jesse, thank you for the $20 super chat. Yes, hello, Ellie. You have a really smart dad that has been hiding from the Twitter universe all of his life, and he just decided one morning to wake up, make an account on Twitter, now known as X. And now 22,000 people care about him in 3 days or something. I don't know how he pulled this off, but he's providing insane value. This guy, for those that don't know, I'm going to put his Twitter in the description because he's just an awesome guy. He is up $2.2 million this year. And the reason he's up this much is not only because he's investing for 25 years and he understands a lot about stocks, but this is the one year where he's really gone heavy on options because this is the year where it's a recovery year. And so underlying assets can go up by 50%. So an option can go up by 400%. And so he's made a lot of right plays. He's made a lot of right calls. He's made a lot of people a lot of money who have gone into some of his plays. So shout out to Jesse. Thank you for being a part of the community. I can't wait till we get him on a podcast one day because it's going to be so cool to hear his story. He's like a self-retired entrepreneur, dropped out of college, killing it in the market. So super, super awesome. How far do you think SoFi will run? Tevis?
Yeah, I think it's going to be a lot. It's going to be depending a lot on if the indexes in general can sustain their run up. I think if they can, then I think we can close above 1150. But it's just the first 30 minutes of the day. We could end on a red day, not for SoFi, but I mean, just in the market on the index in general. But if the indexes can keep running and it's, a sustainable green day, then I definitely think we can definitely, and look, the movement seems strong. We're breaking 1150 again. Who knows, man? It's so short term. I'm not a prophet here. I'm not a magician, but I think that it's going to be on the index.
1150, bro. Hold on. If we break 1152, it's a new 2023 high.
But that's a psychological level, bro. 1150, 12, 10, 1050. So there's going to be a wall there probably.
That's true. That is true. Yeah, I mean, there was a big wall for 19 at Palantir. At first, it was 17, and we crushed that on the Dan Ives report. I mean, we literally we fucking just boulder through it. And now at 19, you would think there's a wall. And this is, I mean, I honestly, either it's an I don't know if retail can pull it up 10% on a day at these levels. So it might be an institution, but the counter argument is that there is so much FOMO happening right now that it might be because a real institution, to be honest, I don't think is buying at $18. I think they're a little bit smarter than realizing, hey, the company is not that profitable yet. We should not be paying $41 billion for it. I've been saying since 15, hey, it's a little bit pricey. But granted, that's where we are in the market cycle. That's where AI is going. And to be honest, if big tech did not smash earnings, Palantir would probably be at $10. Big tech has smashed earnings. The bar has been raised. If they smash earnings as well, then we're in a new market.
The crazy part is like I think as of today, profitable on Palantir after like a long time. I doubled down on my Palantir position. I think I initially bought in like $23, $24 in like 2021. And then I bought again at $7 right before the run up happened. Actually, I bought the same day that they announced AIP. So
Oh,
whenever
wow.
it was in March, like they announced the IP, and I think I bought the next day, something like that. And then my average dropped to like $18, like low 18s, and I just broke into the green on Palantir, I think.
So if I touched 1160, now 1158, so it's above the 1152 level that it hit this morning. Still a $10 billion company. $10 billion company. I mean,
wow.
It is pretty. I think the one thing I do want to say, I made a tweet about this last night, and then we'll get to your question, Jason. I think that's on Tevis's stream. Is if you are up today, this is
Not
the
on mine.
result.
It's on Tanner's.
It's on Tanner. Fucking Tanner making money. We're working overtime for his
passive income. We're sweating over here.
passive income. Okay, so we'll get to that in a second, Jason. I think, I made a tweet about this, that the reason earnings is exciting for us as a community, no matter what SoFi, Palantir, whatever it is because this is the result of intellectually allocating your capital and doing the hard research that it takes to invest in a company. I mean, 99.9% of the world doesn't know what the stock market is. They don't know that they can take a few $100 and throw it into a company and help finance its growth. And so if you're here, if you're part of this community, if you've been following along for the past couple of months, this is the result, if you have some gains today, of what it takes to really do due diligence. Find companies that are working. And look, these companies could go down in the short term as well, but at least for this moment, for today, they had a good earnings. They killed it. And if you have some money as a shareholder in these companies, you're killing it as well because you made a smart decision with disposable capital that you had to be able to invest. And that's something that everyone should be thankful for.
Welcome back, Tom. He's probably on Tanner's channel as well. Tanner's not even here. But let's address this. Do you think shorts are already doubling down from the $4 range to the $9 on SoFi? I think that would be risky. I think if I were shorting a stock, I'd have pretty tight stop losses because that can go against you really quick. SoFi had a parabolic move from 4 to 9 or 10. I think it maxed out at, and then it dropped back to like 8s. If I was holding my short from 4 all the way to 10, I have some serious risk tolerance. So I do think that once it stabilizes at 8 or 9, there's going to be new shorts that pile on. People that think it's going to be falling back into the 6s or 5s. But I don't know. There's definitely people out there that have like sustained shorts over a long period of time. But I think in large part, maybe, I don't know, Mitt, what do you think if you agree or disagree? But I think in large part, like people who are shorting are generally having tighter stop losses than not. But I don't short, I have no idea.
I agree. Yeah. I mean, look, shorting right now is a difficult game. People might think, look, this is a smarter thing to do to short it as it goes. Like the logic for the shorts is that this is market euphoria and it's not justified. The problem is for the past 2 hours, we all broke down the earnings call. It is absolutely justified.
Yes.
This is not like Palantir. I could say it's a little non-justified what Palantir is doing because, the numbers aren't amazing. But on SoFi, you can't say this is a quarter where it's the market's being euphoric. It's like, no, this makes sense. This is a good premium that the market's giving it right now. So if you short it, you have to believe the opposite of that. And that means you just didn't listen to the earnings call. And it's like,
yeah, and that's exactly like, that's a really great point that Amit brought up. Like Palantir is a stock that I would be more likely to be shorting right now than SoFi, just because Palantir has done like a triple in 2 months. Whereas like with SoFi, a lot of their underlying metrics, like it's still early days. And I think the consensus is that it's still early days. They haven't even reached that profitability. Whereas Palantir really had like the perfect storm. They had a year where AI was the buzzword du jour. They had a quarter when they just reached profitability sustainably. And that just lit a powder keg under the stock, right? But again, I think Palantir is way more overbought in the short term from a technical perspective than SoFi is. Granted, I'm not a technical trader.
Steve just texted me. He said Kramer called Noto live. Kramer's coming on at 10:30. Let me call Steve right now and get his thoughts as well. Our resident.
So if we do lose that $11 range, it's going to be because of this.
Because of what?
Because of Kramer.
Because of Kramer. Hello, Steve. There's about 6. Oh, I thought they got answered. We'll see and get some of his thoughts. He's at work. Affirm is up 11%. Yeah, you're seeing all of fintech. You're seeing all of fintech get some love.
Tesla's down. Sad.
Steve's not picking up. Tesla's down. Why do you think Tesla's? All right, so can you give me your thought? What were your thoughts on Q3 earnings? This is one of your biggest positions, right? What did you think about Tesla?
Yeah, Tesla's like 52% of my position. Yeah, man. I mean, I think Cybertruck is going to be really big. I see like my Twitter always like popping up with like new people that have spotted Cybertruck. I think somebody spotted one in Canada. That's going to be really huge. Like when people start to see it on the street. But I mean, look, I think right now people are still looking for the full self-driving, looking for that golden, that silver bullet, so to speak. And the truth of the matter is that similar to SoFi, like they're just still executing on their roadmap. Margins, were lower, but like we expected that. The important part for me for Tesla is that all of the other auto manufacturers, starting with Ford, all of them are slowly moving on to Tesla's charging network. And that might seem like a fairly inconsequential thing in the short term, but the psychological effect, I think, is really huge because it just is an admission, in my mind, an admission of defeat from these players that to say, hey, Tesla has sort of the biggest network out there for charging. What's coming next is full self-driving. Tesla already said in their earnings call that they're probably they're in talks to potentially license it out to another large manufacturer. When the dominoes start dropping on licensing for full self-driving, that's when you're going to see these numbers going crazy for Tesla. So the charging was just the first wall to fall, so to speak, on these traditional auto players adopting Tesla as a leader in the EV space. Next is licensing on full self-driving. When you pair that with the Mexico Gigafactory coming live over the next year, with Cybertruck launching with 2 new products that are going to be announced probably towards the end of this year and starting next year, and with the potential of full self-driving being approved, over the next 12 to 24 months, let's say conservatively, I think you're in for a perfect storm for Tesla there.
Would you be buying Tesla right now or no?
Depends on how long you want to hold it for.
Let's say for 10 years. That's fine.
Yes.
This is a good buy. Okay.
Yeah. I mean, you can definitely get higher ROI on some stocks. Like, for example, if you have a higher risk tolerance, like if you put everything in SoFi can go up way more than Tesla can go up over 10 years from a percentage basis. But I think like I would have zero hesitation putting all my money in Tesla for 10 years, knowing that I'm going to make money throughout that time. Like I'm very confident in Tesla.
I'm reading some of the comments. Someone says, what about all the news that other EVs are uniting to create their own charging stations to rival Teslas? I think the opposite is happening, right? They're all consolidating to Tesla.
Like, I don't know. Like, I don't think it's going to be that huge of a deal. Like a lot of these EV charging stations, like they all have their own adapters. They all have they all have to reach a consensus to band together against Tesla. And that's going to be like Sun Tzu had this amazing, basically talking about, sorry, I sound like with these segues.
That's okay. It's not like Palantir is at 1950. It's not like any.
But look, I think that it's really important because Tesla has one unified vision, one unified direction. And in terms of the decision making that they do, they have one strategy that they follow, one vision that they execute on. Whereas all of these different companies, as a conglomerate party, they have to all band together and they have to all agree on their strategy. That's going to take a lot of red tape. It's going to take a lot of disagreements. And sometimes it's going to be at the expense of the profits of some of those members. There's going to be some of those members in that conglomerate that are not necessarily happy of the decisions that are being made or feel that they should be going in a different direction. And I do think that that is one of the advantages that Tesla has because they have this infrastructure and this network that they can then loop in and bundle with all their other stuff. And it's led by one company with one clear vision that they can execute on. And I think that also just brand value is strong as well. Like with regards to Tesla, it's just, I mean, we talk about SoFi all the time, like that cool factor, like a charging station dude, it's like saying, why would I go to an Apple device versus like if Microsoft and Lenovo and Dell and whatever are all going to get together, because I still want an Apple device. Like it's that brand quality, that brand awareness, and that user experience in general. And I think those are all aspects that Tesla has. So yeah, those are just raw thoughts, largely on process, but I'm not really worried about any conglomeration on the charging network side, especially because look, if they were serious about this, then Ford, which is one of the biggest competitors out there, they would be leading the charge to say, wait a minute, we're never going on Tesla's network. We're going to make a stand because we're starting this, we're starting our own network and we're actually going to sort of eat their lunch. But that didn't happen. Ford CEO was the first one. Jim Farley was the first one to say, hey, look, we're adopting Tesla's network and we think that they're a leader in the space. He literally said a leader in the space. So what do you want?
Yeah. No, I agree. I agree. It's going to consolidate into Tesla, and it seems like it's going to be a no-brainer over the next 10 years just because of how hard it is to vertically integrate a whole charging network. SoFi now at 1124, Enphase at 155, Palantir 1934. SoFi not giving up these $11 gains. It's staying past 11. By the way, put in the chat if you own SoFi and Palantir or one or the other. If it's one or the other, just put the ticker symbol. And then if you're comfortable, say how many shares you own. If it's both, say how many shares you own collectively of both. Let me get your thoughts on Tanner's favorite stock at the moment, PayPal. Are you in this play? Do you like this?
I bought Leaps on PayPal. I think Tanner had some really good DD. Brad Freeman released a really, really great long piece on Twitter. Jesse Dow had really great DD. And as well, Jeremy from Financial Education had some good stuff on PayPal as well. I bought Leaps for now. I don't have shares. I do think that it's a short-term turnaround. It's oversold, and it can definitely get back to the triple-digit range. But I'm not buying shares and holding long-term. I just want to take advantage of the move.
Yeah, that's fair. Same for me. I think 125 is a pretty fair value over the next year and a half. So if it can get to that level, I think that'd be great as well. Palantir now at $19.32. The momentum not stopping. We might see a sell-off a little bit later in the day if people want to take some profits, but at least 20 minutes into the market open or 30 minutes, the market's not giving it a massive sell-off yet. SoFi at 1120. Palantir has about a 6% short interest off 2 billion shares outstanding. SoFi 15% off 959 million shares outstanding. All right, that's pretty much it. So I guess we'll conclude with give me your raw thoughts on SoFi's, I guess concluding thoughts on how you felt about the quarter and the trajectory of the company, and then we'll be out for today.
Yeah, I thought obviously, I'm going to have a full breakdown of SoFi's results, hopefully tonight, but maybe not tonight, maybe tomorrow, because later tonight we're probably going to be doing Stock Tank. But I think
what's the stock for tonight on Stock Tank?
We're not sure yet.
You're not sure. Okay.
We're probably going to decide somewhere today, but I think by and large, people were expecting SoFi to be inching towards that profitability, to be conservative in their guidance and in just their business in general. And SoFi came out and they said, "Hey, look, we are capturing all the members that we can."
They said, "Fuck you, we're taking your lunch, bitch."
That's exactly. In a more politically correct way, that's exactly what they said. And they grew members by 100,000 more than we were looking at, while retaining their same metrics, while lowering their sales and marketing spend as a percentage of revenue, while reiterating the fact that they are going to be profitable by the end of the year. So I think -6 cents EPS was not something that I was expecting. I was expecting something like closer to the whisper number of -4 or maybe -3. But I'm fairly happy with this quarter simply because I know exactly how SoFi is executing, and
so shout out to $20 super chat from Josh. He just saved the stream. He said SoFi.
Did I go to you or Tanner again?
That's me. So Josh, this guy has like $2 million in SoFi, or he $2 million portfolio, a lot of it in SoFi. So
dude, I need to get some of Tanner's sugar daddies on my channel. Josh or Jesse, swing by sometime.
Bro, you have a nice tech job. I'm the one who's unemployed. Okay, you make a decent amount of cash. Look, I think this was a great quarter. I think the numbers that blew us out of the water were, there's two metrics: 584,000 member growth, absolutely insane. No one expected that. And then second is the adjusted guidance on EBITDA being like 70 million more than what we thought they would bring. I mean, that's just insane. That is incredible. And so if you're short this company, you better have a hell of a good reason to short it out at this valuation outside of what management said, because everything else is trending upwards and to the right. Galileo's increasing, financial services going up, barely spent any more money on sales and marketing and got 100,000 new members. So
can you drop this link, Amit?
Yeah, I did. Let me do it again. Yeah. Yeah, for those who are here on my channel, Tevis is a great channel who focuses on SoFi. Well, why are you laughing? Tanner has some hard work. I love. Wait, how many people does he have live? Can we go to how many people does he have live right now?
Well, there's 1,500 here, and I only have 200 of them. So,
bro, there's 534 people taking our.
He has more than double what I have. Oh,
that's
man,
hilarious. Let me get Tevis's channel. Okay, look, if you are a shareholder today in any of these companies, Palantir or SoFi, you should be excited, and you should really. I keep stressing this because I think it's so important. Because my parents never invested their whole life, bro, and now they're they're 60 years old, they're getting older, and my parents, it's not like they're struggling, but they don't have enough to retire right now. And so I'm seeing this shit, and I'm like, oh my goodness, like in 2010, if my dad had just put a couple $100 a month into FANG, he would have a lot of money right now to be able to do. He went more to the real estate, but just a little passive investing. He didn't know what stocks were. And so for me, I kind of feel like it's a duty in my life to educate myself about this, take some risks and see what can happen. And so for everyone here that has allocated capital, whether you're a new investor, an old investor, whether you've got 50,000 shares of SoFi, we got some whales in here, or 200, you are doing something that most Americans are not doing, which is figuring out how they can allocate capital in ways to gain more forms of financial freedom. And that's a really important thing to be able to do right now.
I think that's a perfect note to end on. Noto is going to be on CNBC at 10:30, I think it is. So we can end on that note on the market open, because I think I'm late for an actual work meeting. And
Tevis's channel, I just put it in the chat, so make sure you subscribe to that. And we got one $5 super chat. Someone said, great coverage, closed all my 2023 calls, but believing 2025 leaps. Got tons of $1 calls when price was around $5. Wow, not bad, not bad at all.
Thanks everybody for tuning. Amit, get your shit together.
Oh, the link, I did put the link. Okay, here's a better link. There it is.
This
guy also took my bricks, bro. I was the first brick guy on YouTube, not you. You fucking took my bricks, my guy.
Oh,
gotta get those bricks back. All right, everybody. Thank you so much for joining. We'll see you guys tomorrow on the market open. I'll see you tonight on Finance Junkies. Bye, everybody.
See ya.